We have discussed the specified business list under section 35 AD, building and operating of 2-star plus category hotels and 100 beds hospitals, either 100 beds or more than that, slum redevelopment projects, affordable house construction projects, and cold chain facility, warehouses related to agri produce and sugar, ICD and CFS. Apart from that, semi-fab conductor, wafer fabrication manufacturing unit, and productions of fertilizers as well as honey and bee waxes, laying and operating slurry pipeline as well as cross-country natural gas and crude petroleum oil line network, and finally infrastructure facilities. So these are the specified businesses list we have, and they enjoy some benefits. What are they? Now, to claim the deduction under section 35 AD, okay, it should be this business run by individual, HUF, AOP, BY also, provided if they choose opt out of the default tax regime. If they opt the default tax regime, of course they are not eligible for this one. So if they shift out this, they can enjoy this benefit. In case of company also, they have to shift out the default tax regime. See, 115 BAC class 1A is the default tax regime for individual, HUF, AOP and BY. Similarly, for the companies, they have 115 BAA, 115 BAB. Under these sections, they pay the tax at the rate of, say, 25%, even 22%. Some lesser taxes also there. Some cases, it may be 15% like. They have to shift out of those default tax regimes to pay the regular tax, then can enjoy this section 35 AD benefits, right? Company, if it does not opt for the special provisions under these sections. So what are the benefits they have? New plant and machinery, if they purchase, 100% of such capital expenditure can be deductible, 35 AD. If they claim the deduction under section 35 AD, they cannot claim the deductions under any other sections. Is that okay? Means you are not eligible for section 32 depreciation or scientific R&D expenses or deductions under section 35. Those things not available. Is that clear? And including capitalized expenses related to the prior period before the commencement of the business. So the business commenced and running, and by the time they spend, of course, they can debit to the P&L account under section 35 AD. But they invested all this money in the previous year, and the next previous year only the business commenced. What can we do, sir? Those earlier years spending, if capitalized, then can be deductible in this year of commencement under section 35 AD. And of course, it is eligible for only newly purchased plant and machinery under section 32. You have studied that additional depreciation is eligible. Additional depreciation is eligible for what? Newly purchased plant and machinery should not be second-hand. Similarly, here also, newly purchased plant and machinery will be eligible for claiming 100% deductions provided. Second-hand machine, to the extent of 20%, can be allowable to be deductible, provided that second-hand machine is imported from outside, not used in India. So, imported old plant and machinery on which depreciation not claimed. So, this one, sorry, imported machine as well as 20% can be old. Okay, if 100 rupees worth, 100 lakhs worth assets are imported, means purchased and installed, where 60 being new one. So, definitely deduction is available. To the extent of 20 old one used in India, this one also be eligible. Another 20 rupees worth asset, or this is 50, another 30 rupees worth asset, used one but imported from foreign country, then this is also considered to be deductible. So if it is being imported from foreign country on which any depreciation in India not claimed, then you are eligible for claiming the 100% deductions of such asset in India. This one is also eligible, this one is also eligible. In case of old, only to the extent of 20% is eligible. Only to the extent of 20% is eligible. Is that clear? So new plant and machinery, deduction. Deduction 100% of capital expenditure, no double deduction is permissible. Exceptions. This deduction under section 35 AD is not available for land, goodwill or financial instruments like debentures, bond, any other securities. If you invest, that will not be considered for your deduction purpose. And capital expenditure in excess of 10,000 spent in cash is also not deductible. Already we studied the same one in actual cost calculation. So as per section 43 class 1, if you purchase any capital assets, for that the payment is in the form of cash in excess of 10,000 is not considered as your deductible item. Same way here also, if you are making the payment in the form of cash, more than 10,000 is disqualified. 5,000, okay, no problem. So while purchasing the asset in advance, they may pay around 5,000 rupees as a booking number. That may be in cash, no problem. Up to 10,000 is allowable. Beyond 10,000 rupees, if it is paid in cash, to that the extent will be always disqualified, right? And provided, okay. So this will be discussed subsequently. And in the case of specified business, if there is any loss, that loss can be set off only in specified business, right? See, in the previous year 23-24, PGBP in specified business as well as normal business. In specified business, 100 lakhs loss, normal business 500 lakhs gain. Can I adjust this 100 lakhs here, sir? No, you cannot adjust this. This 500 will be carried forward, means taxable in the PG in the current year itself. Okay. What about this 100, sir? It can be carried forward in the next year. Next year's loss or gain in the specified business will be the base for adjusting this one. For example, in the previous year 24-25, PGBP again. Here we get the specified business gain being 150 and non-specified business where the gain is 600. Now this 100 can be adjusted here. Balance 50 is taxable and this 600 rupees taxable. So 650 will be the taxable income in the previous year. Okay, so whatever the income may be related to the business will be categorized into 3 varieties or sometimes 4 varieties also, right? So your PGBP income will be called as speculation business. Speculation and specified business. Next one being general, non-specified, non-speculation business. Sometimes it may be agri. Agri will be totally exempted. In case of a speculation business loss, this loss will be adjusted only in speculation business itself. Specified, the loss will be adjusted only in another specified business. In case of non-specified or non-specific as well as non-specified business, if there is a loss, this loss can be adjusted in some other non-specific, non-speculation, else can be adjusted here and here. Is that okay? In case of general category business, if there is a loss, it can be adjusted in any of the businesses. But specific loss will be adjusted only in the specific business. Speculation is adjusted only in the speculation. Agriculture is exempted, so you don't consider that part at all. Okay. So speculation, non-specific income can be adjusted in the same head. It means loss may be adjusted in the same head or other head also. To make you understand this concept, let's see. PGBP income. Section 35 AD specified. Here they have 2 business. Okay. One is all about warehouse for agri produce, another one is warehouse for sugar. Warehouse for agri 100 rupees loss and warehouse for sugar 50 rupees gain. And in case of speculation, they have 2 business. One is stocks A, second one is bonds B. Commodity market, commodity through the channel, then it will come under speculation. In A there is a loss rupees 100 and in B there is a gain rupees, it's a loss. Here the gain being 300. Specified, non-specified, non-speculation or general. Okay. So business can be categorized into 3 varieties of business. Business specified under section 35 AD and business involving speculation activities will be called as second block to business. Okay, probably TV showroom. Okay, second one is furniture showroom. Okay, in TV showroom there's a gain of rupees 50. In furniture showroom there's a loss of rupees 400 rupees. How can we adjust, sir? What is the total PGBP income for the current year's taxable purpose? This 50 can be adjusted here. After adjusting, we have 50 rupees loss. What happens to this loss? This loss cannot be adjusted here or here. Okay. So the specified as well as speculation business loss cannot be adjusted in general business. But general business loss can be adjusted in specified as well as speculation. So this 50 cannot be adjusted here. If I am not able to adjust this loss, what can we do, sir? Go for the next year. If the next year gives any benefit, in that profit, this 50 lakhs can be adjusted. So balance will be taxable. Okay. In case of speculation, there's a loss and there's a gain. This loss can be adjusted here. After adjusting, still we have gain rupees 200. 200 rupees. And in case of general, out of 450 rupees is adjusted, 350 loss is there. As already told you, this 350 can be adjusted in speculation as well as specified, but specified has no profit. Only loss. That loss is carried forward. Section 35 AD, PGBP 50 negative, carry forward and set off in the subsequent years. Here there is a gain, here there is a loss. If there is a loss in general, that loss can be adjusted in the specified as well as speculation, but in specified we don't have any profit surplus to be adjusted, but in speculation we have how much? 200 rupees. So 200 can be adjusted. Ultimately 150 remains unadjusted, can be carried forward to be adjustable in the next year's any business income. Specified, speculation or general business. In any business income you can adjust this. Set, carry forward and set off in the subsequent years. But this one can be set off only in which account? Only in section 35 AD business. 35 AD business. Is that clear? If it is being the loss from the specified business, can be adjusted only in the specified business income. In case of speculation, you have 2 or 3 speculation businesses and one business makes a loss. That loss can be adjusted in the gains of the other speculation business. In case of general, one business has gain and another business has loss. The loss is adjusted in the gain. After that also, if I have loss, that loss can be adjusted in the specified business income as well as speculation business income. That's the logic. Clear? Hope now you'll be able to understand. Specified business loss can be set off only in specified business. We'll anyhow study that in detail along with the set off carry forward chapter. It's a separate chapter. I need one session to complete that fully. So A, B, C, the 3 points I have to discuss later on. Okay, let's start with the first question here. Come on. Mr. A commenced operations of the business of setting up a warehousing facility for storage of food grains, sugar, edible oil on 1/4/2024. On 1/4/2024. Okay, all these things are set up only in the current year. He incurred capital expenditure 80 lakhs, 60 lakhs and 50 lakhs respectively on purchase of land, building during the period January 24 to March 24, exclusively for the above business. Okay. So this is prior period, right? This is prior period. And the capital is the same in the books of account as on 1st April 24. Okay. The cost of land included in the above figures, 50 lakhs. So capital expenditure before the commencement. So what are the business we have? Food grains, sugar, edible oils. Edible oils. Overall capital expenditure incurred being 80, 60 and 50. The capital expenditure is for what? Land, building. On purchase of land and building and other things. I am not sure what about the other things. Plus plant and machinery. Okay. On purchase of land and building during the period January 24 to March 24, exclusively for the above business and capitalized the same in the books of account on 1st April 24. The cost of land included in the above figures minus land. Land should be removed. How much is that? 50, 40, 30 should be removed. Okay. He incurred capital expenditure during the current previous year 20 lakhs, 15 lakhs and 10 lakhs respectively for the extension and reconstruction of the building purchased and used exclusively for the business. So balance deductible being 30, 20, 20. Okay. Prior period expenses. current year expenses. Current year expenses related to the building and plant and machinery being 20 lakhs, 15 lakhs, 10 lakhs. So overall amount deductible under section 35 AD being 50 lakhs, 35 lakhs and 30 lakhs. Is that okay? Falls under section 35 AD. Now tell me, food grains and sugar, this is edible oil. Food grains may be agree, sugar also be eligible, sugar, and edible oil we have not seen that. So this will not be applicable for section 35 AD. If section 35 AD is not applicable, then you can claim the depreciation normally. Okay. Compute the income under the head PGBP for the assessment year 25-26 and the loss to be carried forward, assuming that Mr. A has fulfilled all the conditions specified under section 35 AD. The requisite condition under section 35 AD were fulfilled, wants to claim the deduction under section 35 AD and has not claimed any deductions. Okay, the profits from the business of setting up a warehouse facility for the storage of food, grains, sugar, edible, before claiming the deduction under section 35 AD. So what are the, see, before claiming these things, their PGBP income being, okay, 16 lakhs, 14 lakhs, 31 lakhs. Is that okay? Now, section 35 AD, this 50 lakhs can be deductible. Sugar 35 can be subtracted here for sugar. Now, your PGBP income being, how much? First case 34 negative. This is deduction. Here 21 deduction. Now what about this one? 35 AD is not applicable. Edible oil is not falling under section 35 AD. So then what we can do? Section 32 depreciation can be claimable. Okay. Clear? Section 32. So here, leaving the land, this is related to the building. So usually building related to the warehouse and other things other than residential quarters, like you can eligible for claiming at the rate of 10%. 10% on this being 3 lakhs. So balance 28 lakhs. Now in these two specified business loss, but here there is a gain. What about this one? Can we set up this? No, we cannot set up the non-specified business, specified business into the non-specified business income. So the 28 lakhs is the taxable PGBP here, and this can be carried forward and adjustable in the future. Okay, in the future. These two cannot be adjustable in the current year. Clear? Any doubts here? Come on, make a note of it. So 3 business where we identified the specified business and non-specified business. And in non-specified business, we can claim the depreciation. For the specified business, we don't claim the depreciation because 100% of capital expenditure can be deductible. We did the deductions already. So once the section 35 AD benefit is enjoyable, then you cannot enjoy the other benefits. So double deduction is not possible. As you have claimed 100%, you are not eligible for claiming the section 32 benefit, right? No double deduction is enjoyable here. Shall I move to the next one? Make it faster. Clear? Now let's move on to the next one. Mr. Suraj, a proprietor, commenced operations of the business of a new 3-star hotel in Madurai on 1/4/23. He incurred capital expenditure 50 lakhs during the period January 24 to March 24, prior period expenditure, exclusively for the above business and capitalized. Prior period capitalized means capital expenditure can also be deductible provided if it is capitalized. Of course, this is eligible for deductions. Okay. The same in his books of account and 1st April 24. Further, during the previous year 24-25, he incurred capital expenditure of rupees 2 crores, out of which 1.5 crore was acquisition of land. This is not eligible. So out of 2 crores, no, 1.5 crore is for the land, only 50 lakhs can be claimable for the deduction purpose. Okay. Compute the income under the PGBP for the assessment year 25-26, assuming that he has fulfilled all the conditions specified under section 35 AD and apted for claiming deduction under section 35 AD. They wanted to go for this section benefit. He has not claimed any deductions under chapter number 6A. Means they should not claim any other benefits other than this one. So that's how the statement gives you. They have not enjoyed any other benefits. Okay. So as they have not enjoyed any other benefits, automatically section 35 AD benefits will be enjoyable. The profits from the business of running this hotel for the assessment year 25-26 is 25 lakhs. Okay. 3-star hotel. PGBP being 25 lakhs. Assume that he has also another existing business of running 4-star hotel. 4-star. This is old one. Okay. 35 AD is available only for the newly started business. For this is already running business, not eligible. Not eligible. But these two are hotel only, no. So these two are specified business, but section 35 AD is available only for the 3-star hotel, not for the 4-star hotel. And which commenced operations 15 years back, the profits from which are 120 lakhs. For this, the profit being 120 lakhs. Now, section 35 AD benefit is available only for what? 3-star hotel, not for this one. So, what is the total benefit can be enjoyable? Prior period capitalized expenditure 50 lakhs and current year expenditure other than land can also be deductible, which is 50. So 50 plus 50, 100 lakhs can be deductible. So 75 lakhs here loss and here 120 lakhs. Now the question is, can I adjust this 75 lakhs in this business income? Of course you can adjust this because both are specified businesses. Okay, 2-star category or above that will be considered as specified business. If one business has a loss, that loss can be adjusted in the another business. So automatically what happens? Balance 45 lakhs is the taxable PGBP here. This is set off. So taxable PGBP. So Apollo hospitals, okay, already they are running since very long ago, right? If they want to start a new business, new hospital, minimum they have to keep 100 beds. All the capital expenditure they spend for creating a new hospital can be debited with their existing business profit. The profit is reduced and they pay lesser taxes. Isn't it? Already there is an Apollo hospital and it's a profit making one. So now what they can do, they can establish one more hospital with 100 plus beds, so they can enjoy the benefits, the building cost, and then all the facilities they incur for constructing the whole hospital. Everything will be over. Everything can be debited. So by debiting all these expenses in the revenue is very cheaper or very lesser, and tax will also be very lower. Right? Hope now you'll be able to understand this one. Shall I move on to the next one? Most probably, if time permits, we may try to finish off PGPP by today itself. Our small content may be left over, can be completed by Sunday at the maximum. Okay. Clear? Now, Mr. Arnav is proprietor having two units. Unit A carries an specific business of setting up an operating warehouse facility for storage of sugar. 2 unit. Unit A. This is warehouse for sugar. Means section 35 AD business, specified business. Unit B carries non-specified business. So they have one more unit, unit B. Okay, not falls under section 35 AD. Business of operating warehouse facility for storage of edible oil. This is also warehouse, but for edible oil. For edible oil. Unit A commenced operations on 1/4/23 and it claimed deductions of rupees 100 lakhs incurred on purchase of 2 buildings for rupees 50 lakhs each. It claimed deductions of 100 lakhs and incurred on purchase of 2 buildings for 50 lakhs each. So they have purchased a building. $50 lakhs each, 2 building for operating warehouse facility for storage of sugar. Under section 35 AD for assessment year 24-25. So assessment year 24-25, otherwise previous year 23-24 and assessment year 24-25, they could have claimed 100 lakhs completely as deduction. Okay, deduction under section 35 AD. Am I right? So they purchased the building for unit A and claimed the entire expenses as deduction under section 35 AD. However, in February 25, unit A transferred one of its building to unit B. In the current year, one of the building is transferred. So 1 out of 2 is transferred. Purchased for specific business, but later on transferred to the non-specific business. Similar scenario we already studied in scientific R&D. Asset purchased for scientific R&D, later on the asset is transferred for the regular business, not for R&D purpose. If any asset purchased for the R&D and transferred for the non-R&D, means non-R&D purpose, automatically what do you do? The cost of acquisition will be considered as 0 and added to the block of assets. That's how we learned earlier. Similarly, the asset used for specific business claimed 100% depreciation under section 35 AD. Later on transferred to the unit B, non-specific business. Should not be transferred at least minimum 8 years. If you are transferring, then automatically what happens? The treatment will be pretty different. Here, on what date it was purchased? Opening WDV on 1/4/23 being 50 lakhs. Only one asset transferred. Claim the depreciation for the year 23-24. As it is being the building, and this building will have rate of depreciation being 10%. For the first year of usage, 5 lakhs has gone. So 45 lakhs will be the WD value. This is what about the WD value. Actually, this is not a process, but notionally we calculate if the asset used for scientific means a specific business transferred later on to non-specific business, you have to claim the depreciation notionally. What could be the depreciation? So the rate of depreciation applicable for this being 10% if this business is not being the specific business. Claim the depreciation if it is not being the specific business and find out the WD value. This is the WD value at which it is transferred. Automatically in unit B, the actual cost is equal to 45 lakhs. For unit A, PGBP income under section 28 is equal to 45 lakhs. Clear? If the asset used for the scientific means a specific business purpose and they claim deductions 100% under section 35 AD, later on if it is not used for that purpose and transferred to the non-specific business, claim the depreciation notionally. Find out the WDV as on the date of transfer. The WDV will be the actual cost for the transferees department and the WDV value will be the PGBP income for the transferor unit. Is that clear? Section 43 class 1 actual cost calculation. Here I left one thing to be discussed. Okay. The 13th point I already told you to discuss later on. Huh? Yeah, always the last year on transfer we don't claim the depreciation, right? In WDV on the year of transfer we don't claim. Asset transferred from specified business to non-specified business after 8 years, then cost will be nil. But if it is transferred before 8 years, then what happens? The way how we have calculated will be incorporated. If it is transferred before 8 years, notional depreciation is deducted and that will be the actual cost. After 8 years, no problem. So section 43 class 1 is over. In section 28 also one point left untouched. Let's now rebrief that. So here, 9th point. In case of deductions claimed for capital assets under section 35 AD, okay, specified say 100 lakhs and section 35 AD deductions claimable 100 lakhs. Okay, few years later, 3-4 years or even 10 years later, if it is sold for rupees 5 lakhs, the sale value will be the PGBP. Sale value will be the PGBP. Point number 1. If you are selling, then the sale value will be the PGBP. Okay. Now, if you are transferring the asset from specific business to non-specific business after 8 years, cost of acquisition is equal to nil. Later it is added to the block of assets and normal depreciation will be provided as per the depreciation chapter. But if the asset is transferred within 8 years, then what happens? For this specific business, cost of acquisition minus notional depreciation since the date of purchase to the year of transfer, and this will be the PGBP income. Okay, under specific business section 28, and this will be the cost of acquisition as per section 43 clause 1, actual cost. So transfer to non-specified business within 8 years, section 35 AD clause 7 deemed income will be applicable. This will be the deemed income. Okay, deductions claimed under section 35 AD minus notional depreciation. Usually deductions claimed being 100, notional depreciation may be assumed say 40 rupees is claimed. 100 minus 40, 60 rupees will be the PGBP income. As per section 43 clause 1, actual cost is equal to deductions claimed under section 3580, which is nothing but actual cost minus notional depreciation may be 40 rupees. The WDV will be the actual cost for the transferee department. Transferee department. Hope you will be now able to understand. The asset purchased for the specific business, 100% deduction is eligible. And later, sometimes usage, late after sometimes of usage, if you sell, it's the income only, section 28. But after 8 years, if it is transferred to the non-specific business, no need to worry about that. The cost of acquisition 0 will be addable with the consent block of the transferee department. If it is saleable, if it is transferred before 8 years, you have to subtract the notional depreciation from the original value or amount actually claimed as deductions, and balance will be your PGBP income. That WDV value will be the actual cost under section 43 clause 1 for the non-specific business. Hope you will be now able to understand this one. After 8 years, then it is the cost of acquisition being nil only. Clear? Yes, come on, make note of it. So with that, section 28 is also completely over. Section 43 clause 1 also completely over, and 3580 is also over. Make note of it. If you have any doubt, you can ask me. If it is clear, text me. Now let's move on to the next one. Section 35D. Section 35D. Deductions with respect to preliminary expenses. At the time of commencement of the business, there may be huge preliminary expenses, right? That preliminary expenses can be amortized over 5 years period. Okay. For new business commencement or setting up of a new business or extension of the new unit. For this, the section 35 AD will be applicable. Very simple. As per section 35 AD, sorry, 35D, whichever is lower of qualifying expenditure for starting a new business, and second one is whichever is higher of 5% cost of project or 5% capital employed. This capital employed is applicable for the Indian company. This is a simple format. So you calculate this one, calculate these two values, and between these two, whichever is higher will be taken. Between these two, whichever is lower will be taken. This can be amortized over 5 years in the year of commencement plus 4 additional years. That's all. Let's see. Jardine Limited is an existing Indian company which sets up a new industrial unit. It incurs the following expenditure in connection with the new unit. Okay, what are they? Whichever is section 35D deduction, preliminary expenses. Whichever is lower of qualifying expenditure, whichever is higher of 5% of cost of project, 5% of capital employed. Preparation of project report, also part of preliminary expenses. Market survey to whether you can sell your product or not. Legal and other charges for issue of additional capital required for the unit, 2 lakhs. So all these things are around 11 lakhs is considered as qualifying expenditure. Cost of project as well as capital employed are there. Qualifying expenditure being 11 lakhs. 5% of cost of project being 30 lakhs. How much is that? 1.5 lakhs. And 5% of capital employed 40 lakhs, 2 lakhs. Between these two, whichever is higher, 2 lakhs. Between these two, whichever is lower, 2 lakhs. Can be amortized over 5 years, means 40,000 can be claimable in the previous year 24-25, and thereafter also you can claim 25-26, 26-27, 27-28, and 28-29. So you can claim in 5 installments. Clear? This 35D is very simple concept. But anyhow, let me explain what is called qualifying expenditure. What are comprising the cost of project and capital employed all in detail, and who are eligible and what kind of businesses are eligible. So that theory part also we will complete. Okay, shall we move on to the next one? Here, new business commencement or setting up of new business or extension, for that it can be used. That too by Indian company or resident non-corporate SSC. For that only this will be eligible. And you need to submit audited details also along with deductions. Whichever is lower of 1 and 2, deductible in 5 years equally. Qualifying expenditure, second one is whichever is higher of these two. After amalgamation or demerger, the transferee Indian company is eligible. C. 2 lakhs. Can be claimable over 5 years means 40,000 rupees per year. A company claimed for 24-25 current financial year, 25-26 second year. Thereafter, A company merged with B and A is now closed. What can we do, sir? For the remaining 40 into 3 years, 26-27, 27-28 and 28-29, B company can claim the deduction under section 35D. And qualifying expenditure means legal charges for drafting any agreement and printing of MOA, AOA, Memorandum of Association, Articles of Association, drafting and printing expenses, registration fee of the company, public issue of shares and debentures involving any expenses that will also be considered as qualifying expenditure, feasibility and project report also be a part of this one, market survey. These are the small idea you have to keep in your mind for the qualifying expenditure. In case of cost of project, okay, for setting up an extension of new industrial unit, cost shown in the books on the last day of the previous year. Last day of the previous year. Okay, 1/4/24 and ends on 31st March 25. The preliminary expense, the cost of project should be as on 31/3/25 will be taken here for the calculation. Actual cost of fixed assets, and not only that, any development of land and building will also be taken. Of course, land will not be taken. Okay, development cost incurred on development of land and building can be taken. Okay. Now, capital employed, issued share capital, debenture, even non-current liabilities, provided the non-current liabilities will have maturity by a year being more than 7 years. More than 7 years. Reserves fund, including securities premium, not considered, not applicable. So there may be lots of confusions. One word questions also we expected, whether the securities premium forming part of the capital employed or not. Such a question out there. So specifically it's stated in a judgment. Okay, whenever we talk about capital employed, it's only capital invested, not from accumulated reserves. So the reserve fund and securities premium will not be considered as capital employed. Is that clear? These two will not be taken care of. But in case if it is not being the company, capital employed concept is trouble, then what can we do, sir? So then this point will not be taken. This is applicable for Indian company. In case of resident non-corporate assessee, only these two are taken. Qualifying expenditure, 5% of cost of project, whichever is lower will be taken. Is that clear? The second part will not be applicable. Hope now we'll be able to understand the other theory part also. Now we'll start with section 36. Section 36, specified deductions. Specified deductions. Okay. Those expenses listed here, as per the conditions and provisions, you can claim the deductions from your PGBP income. You prepare trading and P&L account, find out the net profit. Can the net profit being the taxable profit means? No. So you have to read all these provisions and understand whether as per this provision deductible or not. So based on that you can make the decision. Is that clear? Okay. Section 36, class 1, subclass 1, insurance of stocks. Insurance of stocks. Clear. If you are insuring the stock, you can definitely debit that to the P&L account. In your P&L account, stock insurance cost maybe 100 can be debited. If it is not debited, no problem, you debit it further. Okay, if you are already debited, do no adjustments. Whether it is adjusted or not, go and verify. Is that okay? So the amount of insurance premium paid in respect of insurance against risk of damage or destruction of stocks, stores used for the purpose of business is allowed. Okay. What about the purchase of stock, sir? Stock is deductible only. Any goods you purchase, otherwise you cannot run the business, right? All the expenses you incur related predominantly for the business can be debited in your P&L account. Because Section 36 is all about specific deduction. Section 37 is all about general deductions. Okay. So these two main sections you have to be mastered to understand whether the particular expenses can be debited in your P&L account or not. So only these two sections. One is section 36, another one is section 37. Section 36 says specified, section 37 says general. Okay, specified means if I say particular feature, particular expenses name, that only can be debited. General means I will give the criteria. If any expenses you incur, if those criteria are satisfied, then it is claimable as deduction. Is that okay? If I call stating some person's name, definitely that person should come, right? If I say Mr. A should come here, then you just go and call Mr. A. Is that okay? Otherwise, if I call 3 or 4 students here, then immediately what's the question? We want to move a bulk bureau, heavy bureau. Then immediately in the classroom, you just go and see who are capable of lifting the 4 bureaus. So you need to now find out the characters required for the job and the pick. Similarly, any expenses revenue nature related to the business can be debited under section 37. So you just think over that expenses being the capital or revenue. Okay. Is it relevant for the business? Yes, sir. Without this business cannot be operated. Then you can debit to the P&L account. If I say bring A, then you have to bring A only. The same comes under section 37. 6. Specified deductions. If I tell you deduct only the insurance of stock can be debited. Okay. Insurance of building, not stated here. So insurance of stock can be debited to the P&L account as per section 36, class 1, subclass 1. Subclass 1. Clear? Oh, sir, we need to debit insurance for the building also, plant and machinery also. You can debit, but not specified here. Then it is related to the business. If you prove and revenue nature can be debited in your P&L account as per section 37. Section 37 says characters. Section 36 says the confirmed expenses. Okay. Now, 1B. Insurance premium on health of employees. Insurance premium on health of employees. Very simple. I for insurance. IB insurance again. I represents insurance. Similarly, you can register that in your mind. I for insurance. Another IB is also for insurance. In case of stock insurance, no problem. You can insure. But in case of health insurance, some conditions should be satisfied. What are they? It should be a group health insurance. That scheme is framed and approved by the central government or IRDA, Insurance Regulatory Development Authority, General Insurance Corporation. Okay, should be approved by General Insurance Corporation and approved by central government or any other insurer or approved by IRDA. Third one is the premium should be paid through check, not by way of cash. Whenever I use a term check payment, it means it may be account pay check, bearer check also. Even DD also be eligible. Not in the form of cash. Not in the form of cash. Note here, RTGS, any other online mode of payment will also be eligible. But not in the form of cash. These are the 3 conditions should be fulfilled to claim the deductions for the insurance premium paid for the health of employees. One is it should be group in the health insurance. That scheme is framed and approved by the central government or IRDA approval. Or it should be the premium should be paid not in the form of cash. These are the 3 things. Okay. So what happens, sir, in case of LIC premium or accident insurance premium, can it be deductible? If you prove that it is related to the business, then of course you can claim that under section 37. So I for insurance, 2 items covered. One is insurance for the stock, another one is insurance for the health of employees. Insurance for stock, no problem. Any premium you pay can be debited. In case of health of employees, the scheme should be framed as per the provisions given in IRDA and approved by the central government. And group health insurance scheme, it should be, the third one is, it should be not in the form of cash. Not in the form of cash. Now, we'll move on to the second clause. Section 36, class 1, subclass number 2. Bonus or commission. Employees are paid salary, bonus, and whatever it may be. Bonus and commission also be debited in your P&L account, not only the basic salary, HRA, whatever the income of the salary you studied under salary chapter, payable by the employer can be directly debited to the P&L account. No problem here. Okay, no problem here. Provided it can be claimable only if it is paid to employees. In case of salary, even being it's outstanding, can be debited to the P&L account. But in case of commission and bonus, before 31st March or before the due date of filing of return of income, it should be paid. What is called paid, sir? What is called paid, sir? We'll study that in detail under section 43B. Section 43B. Okay, list of expenses are there. Those expenses can be claimable as deductible. Claimable only if the payment is made within the specific date. Within the specific date. Is that clear? Section 43B. Now, before I study this one, let me finish up section 43B and then I'll get back to this one. Section 43B. Okay. Now, deductions allowed on payment basis. Deductions allowed on payment basis. Okay. Now, any payment to government and approved schemes will be deductible only on payment basis, or for loan if you are making any interest payment also. So you can keep these things in your mind. One is all about government payment or government schemes payment. Another one is interest payment. Here we have 2 items, here we have 3 items. Apart from that, employer to employee payment, employer to employee payment. Here we have 2 items. Okay, one is all about bonus and commission. Another one is leave encashment. Leave encashment. Leave encashment. So 7 items. And you can include railway also. Indian Railways. Indian Railways also. Last one is MSME. Micro, small and medium enterprises. So these are the set of items. For them you can claim the deductions only if the payment is confirmed. As per section 43B, payment should be done before the due date of filing of return of income. See previous year. Starting date being 1/4/24, ending date being 31st March 25. Okay, payment is considered within the due date. Payment is over if the payment is done before 31st July 25. If audit not required. Audit not required. If your books of accounts not required to be audited, okay, so then you have to report your income statement to the government and pay the tax before 31st July 2025. Okay, in that assessment year, 31st July. Means once the year is over, within 4 years, you assess and intimate to the government, this is my income and I am paying the tax. Clear? 31st July. Clear? So from 31st March to 31st July, so 4 months are there. Clear? If audit is required, what happens? Still extended days there. 31st October will be taken. Another 3 more extra month will be given. If my books of accounts are to be audited by the chartered accountant, of course it takes some more time, right? So when the audit required, then the date is extended by another 3 more months. If I involve in some other foreign transactions, okay, then further increased by another 2 months, like, okay, clear. Hope you will be now able to understand. So you just check whether the entity falls under audit case or non-audit case. If the entity falls non-audit case, the payment before 31st on or before 31st March, 31st July of the assessment year is considered as paid. You have to attach the bill, then it's over. Clear. Similarly, audit required 31st October will be the last date. Before that date, if you are making the payment, it is considered as paid. But in income from house property, no. Municipal tax can be deductible only on payment basis. That's how we studied there in income from house property. The payment should be made before or on 31st July, sorry, 31st March of the same previous year. Okay, in case of municipal tax, it's within the same financial year. In case of the payment under section 43B, the payment should be done on or before the due date of filing of return of income. The due date of filing of return of income will study along with the return of income chapter later on. Okay, so in that it is clearly stated requires no audit means you have to file your return of income by 31st July. If you need to audit and then file the return of income, and 31st October will be taken. So if the payment for these things are done on or before the date, will be considered as payment is over, you can claim the deductions. Else what happens, you can claim the next year. Else you can claim the next year. So pay before the due date for filing ROI, okay, ROI except 43BH, except this one. For this it is totally different. I'll see that later on. Okay. So first these two, government payment, tax, duties, cess. Second one is government services, means schemes like RPF, PPF, superannuation fund, NPS contribution as per the law, as per the statute. Right. In case of interest, we have three types of interest payment. One is interest on loan or borrowings, where the borrowings are from public financial institutions, state financial corporation, or state industrial investment corporations, NBFCs, non-banking financial corporations, public financial institutions, state financial corporations, state industrial investment corporations, or any other NBFC. Okay, a deposit taking NBFC or systematically important non-deposit taking NBFC. Deposit taking NBFC, systematically important non-deposit taking NBFC. These things you will study at your inter level. I think advanced accounts you have, I think. Okay, so you have there, you will study all these things later on, not here, banking companies. Okay, now forget about this one, that's an old one. Now it's applicable. Last one is if you are borrowing the loan from scheduled bank and cooperative bank, not being primary agricultural credit society, primary cooperative agricultural and rural development bank, not related to the rural branches, rural banks. Okay, primary agricultural credit society, primary cooperative agricultural and rural development bank. So leaving these two, any other scheduled bank and cooperative bank, if you borrow from them and the interest remains unpaid, will not be deductible. And NBFC, the interest remains unpaid, cannot be deductible. PFI, okay, public financial institution, SFC. For that, any interest payable remains pending, cannot be deductible by debiting to your P&L account. You cannot debit that to the P&L account. Hope so. You could not interest payable to public financial institution, non-banking financial corporation, scheduled bank and cooperative bank not being agri or rural. Okay. And in case of any payment by employer to employee other than salary like bonus, commission, and leave encashment, can also be deductible only on payment basis. Can also be deductible on payment basis. Clear? Now, Indian Railways. If you are using any Indian Railways property, dues for that should also be paid before the due date of return of filing of return of income. Okay, any property here installed in the railways premises, corridors, and even restaurants. In Trichy railway stations, after the renovation, you find lots of restaurants, A to B, and others also installed, and Saravana Bhavan, Vasant Bhavan, I think. Okay, so many restaurants were there. For that, they have to pay the money for whom? To the Indian Railways. Any assets you are using related to the Indian Railways, for that due is not paid within the due date of filing of return of income, you are not eligible for claim the deductions. Is that okay? Payment to Indian Railway for use of railway assets, Is that clear? Hope so. First one is government and government scheme and Indian Railways. Another one is interest, three interest. Okay, public financial institution. Okay, public financial institutions and scheduled bank and NBFC. Third one being bonus, commission, leave encashment. Okay, so here 2 items, 8 items over. Okay, 1, 2, 3, 4, 5, 6, 7, 8 over. Except the last one, we have completed all. Section 43B is over. Section 43B says deduction is allowed only on payment basis. Payment means within which date you have to make the payment. Pay before the due date for filing ROI. Before the due date for filing the return of income. The due date for filing of return of income under section 139 clause 1 will study a separate chapter called return of income chapter. I need one session for that. Okay, small briefing. Anyhow, the core points are covered here. As per section 139 clause 1, if your books of accounts required audit or not. If audit not required, then you can file 31st July from the year end of previous year. Okay. Once the previous year over, from there within 4 months you have to file the return of income. In case audit required, another 2 months. Now you will be able to understand. What happens for MSME, sir? For that ROI will not be applicable. That may be pretty different. Right. Let's see here. Allowed as deductions only in the year of actual payment. Okay, actual payment. But deductions allowable on the due basis if payment made within 15 days from the acceptance or deemed acceptance by the buyer. Okay. In case of written agreement, payment should be made within 45 days from the acceptance and deemed acceptance by the buyer. Okay. So this is the main thing you have to understand. In case of MSME, 1/4/24, 31st March 25. Payment should be before 31st March 25 itself. Only then it is eligible. Some cases 25th March 25 MSME sold goods to A Limited and A Limited remitted payment, goods transferred. A Limited remitted the dues on 5th April 25. So not paid within the same year but taken around 10 days. What happens in this case, sir? In this case is allowed. 15 days gestation period is given. Payment made within 15 days from acceptances. Goods sent, he says, okay, I will take this goods. The moment he accepts from the date, 15 days is given time. Within 15 days, if he makes the payment, no problem. He can still consider as payment is done and can claim the deductions. For example, exactly on 31st March 25, goods are transferred from MSME to A Limited. Okay. Micro, small and medium enterprises transferred to A Limited on this date. From that date, 15 days may be taken. Or if there is a written agreement, I will take at least 30 or 35 days. As per the written agreement makes the payment, 45 days will be taken. Another 45. Written agreement is given. Sir, I will settle that, sir, within 1 month. Okay. Then 45 days will be taken. Okay, to encourage the MSME's dues to be paid on time. Okay, because they are suffering cash crunch. So big companies should remit on time. That's a case we have here. Payment made within 15 days from the acceptance, deemed acceptance by the buyer. In case of written agreement, payment should be made within 45 days from the acceptance and deemed acceptance by the buyer. Okay. Now, micro small enterprises. What is called micro enterprises? Okay. What is called micro enterprises? Investment in plant and machinery and equipment, PPE, plant and machinery equipment, less than or equal to 1 crore, or turnover is less than or equal to 5 crores, then it is called micro enterprises. Beyond that and less than, you just multiply with the 10 number. 10 crores and 50 crores beyond this, then it is called small enterprises. Okay. So up to 1 crore investment or 5 crores of turnover will be considered and. Okay, it's not or and. Okay, investment value should be less than or equal to 1 crore and the turnover should also be less than or equal to 5 crores, considered as micro. 10 times bigger, 10 crores for the investment and 50 crores being the turnover. Okay, less than that means beyond 1 crore, less than 10 crore will be considered as small. Beyond 5 crores and less than 50 crores will be considered as small. Thereafter, it becomes large. Is that okay? Clear? Now, A Limited SBI company, SBI bank borrowed 100 lakhs. A has to pay the interest at the rate of 10%. 10 lakhs should be payable. Okay. This is on 31st March 25. The amount payable on 31st March 25 for the loan being 10 lakhs, 10%. This is what about the original loan. But remains due unpaid. Even A requires audit. So 31st October 2025 unpaid. Just before this date, for the interest, they simply issued debentures of A company to SBA for rupees 10 crores, 10 lakhs. Sir, I don't have 10 lakhs to be paid immediately. Instead of that, I offer you 10 lakhs rupees worth the debenture. Now, can this 10 lakhs debited in your P&L account as interest payment is done? No. Interest payment means it should be paid. Actually, it should not be converted into additional loan. Here, that 10 lakhs outstanding interest is converted into additional loan by issuing the debentures. Or this 10 lakhs rather than the debenture may be raised as a further loan with the SBI. So, A has borrowed 100 lakhs. 1 year later, 10 lakhs should be payable. So, A demands, sir, I cannot pay 10 lakhs. So, you raise the loan amount by 110 lakhs. This 10 lakhs will be adjusted as a loan amount. So, hereafter 110. If I am raising the loan from 100 to 110 lakhs, the additional 10 lakhs is considered as payment of interest, means not accepted as this provision. You have to originally pay that later on. On original settlement of this debenture or the additional loan will be considered as interest payment by the time you can claim the deduction. Right. Debenture or any other instrument given for deferring the payment of outstanding interest. Sir, outstanding interest, I cannot pay the money now. Take the debenture for that. Or give me a further loan for this outstanding interest. If you are doing this way to settle the interest, this shall not be treated as payment. Then when can I consider this being the payment to be deducted, sir? The moment when you are paying this debenture later on, or when you are paying that further loan later on, by the time only you can claim the deductions under section 43B. 43B. Clear? Hope now you'll be able to understand. Now, we'll move on to the next one. Mr. A purchased goods for rupees 10,000 from A & Co, a micro enterprises on 1325. Okay, MSME, A & Co. From there, goods are transferred to A. As per the written agreement between them, the payment has to be made on 5th April. So the date of sale being 1325. Written payment as per the written agreement to settle this being 5/4/25. So between these two, the days is more than 1 month. 31 plus 5, almost 36 days or 35 days. Mr. A follows mercantile method of accounting, determine the taxable year for the deductions of Mr. A. In case of Mr. A, in the previous year, 24-25, interest can be deducted. Interest can be, or payment can be deductible. Expenses payable to A & Co, MSME can be deductible, where the amount is paid on 2nd April 2025. The payment actually made on 2nd April 25. Before the agreement date, payment is made, so this is deductible in the previous year 24-25 itself. Clear? Scenario 1. Scenario 2, if the payment is made rather than as per the agreement date, they made the payment on 20th April 25. Okay, what can we do, sir? Okay, this cannot be deductible in the previous year 24-25, can be deductible only in the actual year of payment, which is 25-26. Previous year 24-25 not eligible. Previous year 25-26, assessment year 25-26, they can claim the deductions. What's there, sir? Any of they can claim the deductions solely, sir. Rather than claiming here, if you are claiming later, you have to pay the tax ahead now itself. 1 year ahead, you have to pay the tax. Probably, if the value being 10,000 rather than 10,000, it may be 10 lakhs. 10 lakhs means as they are not eligible for claim the deductions the previous year 24-25, profit will increase by 10 lakhs. For that 30%, 3 lakhs you have to pay the tax unwantedly. For 1 year's period, interest on the 3 lakhs may be around 30,000 rupees, 35,000 rupees as unwanted loss only, no? So, inducing you to pay much prior to the due date so that you will be eligible for claiming the deductions in this year itself. Okay, clear. Hope now you will be able to understand MSME case. MSME case. Shall I move on to the next one? Now, X Limited follows mercantile system of accounting. What method can be followed, sir? Is it mercantile system or cash system? You can follow either mercantile or cash system. There is no any harm. In case of PGBP as well as income from house property, income from other sources, in these two cases, you can follow either mercantile system or cash basis. Whatever the method you regularly follow, you can follow. After negotiation with the bank, interest of 4 lakhs, including interest 1.2 lakhs pertaining to the year ended 31st March 25, has been converted into loan. Debenture is given for settlement of the outstanding interest. X Limited and bank. So they have borrowed loan. We are not aware about how much is payable. Okay. So here, outstanding interest. Outstanding interest payable 1.2 lakhs plus 2.8 lakhs. 4 lakhs including 1.2 lakhs pertaining. This is converted into loan. So this interest is now assumed to be settled by issuing the debenture. Okay. Now the question is, can the interest 1.2 lakhs so capitalized be claimed as business expenditure or not? In the P&L account, can that 1.2 lakhs deductible or not? Now the question is it actually paid? No, it is not actually paid. That interest, outstanding interest is converted into a new loan. So you are not eligible for claim the deductions here. 1 or 2 years later, if you are repaying this debenture or some other loan, debenture or new loan, the moment you pay this, in that year you can claim the deductions. In that year you can claim the deductions. Is that clear? So whatever the outstanding interest, for that you have to settle in the form of cash. If you are not able to pay in cash, you are raising further loan for that. That further loan remains your loan only in the balance sheet, not deductible in your P&L account. But originally that further loan or debenture is paid later on. By the time you can claim the deduction. By the time you can claim the deductions. Hope you will be able to now understand this one. Now let's move on to the next one. Interest on bank term loan paid during the year 24-25 was 1,21,000. Outstanding on 31st March 25 was 28,000. So the loan is 1,21,000. Borrower, bank. The original loan being 1,21,000. For that, outstanding interest being 28,000 in the year end. The assessee paid 15,000 before the due date of filing of return of income. In this, paid, okay, before the due date of filing of return of income under section 139 class 1. Section 139 class 1 states the due date for paying the means filing the return of income. Okay, we'll study that along with the return of income chapter, right? So out of 28,000, 15,000 paid before this date. Is the amount paid after the end of the year eligible for deduction? Now question is, can it be deductible? So not necessary that you can pay within 31st March itself. Even though if you are not paid within 31st March, you have extended time. That extended time is nothing but the due date for filing of return of income. The due date of filing of return of income being either 31st March, April or 31st October. So here we'll see 31st July. Sorry, 31st July. So no audit means 31st July, and audit required means another 3 more month will be addable, 31st October. Clear? So with that, section 43B is completely over. Today we completed illustrations on 35 AD, and then we completed 35D, preliminary expenses. Then automatically we have to jump to section 36, specific deductions. In that we have completed 1 and 1B related to the insurance. 2 is all about bonus and commission. Before I discuss that one, I jump to section 43B. Okay, 43B. Okay, 43B lists the items to be debited to the P&L account on payment basis. Payment means usually pay before the due date of filing of return of income, except one case. In case of MSME, any payment to the MSME, the payment is as per the terms of agreement. Right? Clear? Now, let's start. So if you are thorough with this chapter, you are already almost ready for passing the exam. You can score anywhere between 35 to 40 up to this chapter. Okay, leave the other chapter. If you are master with this chapter, you will be scoring around 35 to 40 marks. Okay, so claiming exemption in this income tax is pretty simple. Okay, bonus or commission paid to employees, deductible subject to section 43B, means paid before the due date for filing of return of income. Bonus means like Diwali bonus, production bonus, etc. The employer may fix in this year as a entire workers team should produce 1 lakh units. The employees produced 1,20,000. The management is very happy for the additional productions. They are giving some incentive like bonus, can be considered, but not in the form of distribution of profit. It should not be in the form of distribution of profit, right? So if the bonus is in the form of distribution of profits, not eligible for deductions. Is that clear? Hope now you'll be able to understand. Now, section 31 class 1 subclass 3, section 36 class 1 subclass 3. This chapter, this particular section, you have to refer section 43B and 43 class 1. Section 43 class 1 is all about actual cost concept. Section 36 class 1 class subclass 3 is all about interest. Section 43B is all about payment basis. So you have to study all the three sections put together as a whole. Okay, give the cross references. Now, 1424, 31st March 25, loan borrowed 100 lakhs and plant and machinery got installed and started construction or utilization from 1/1/25 onwards. During this period, it was under the process of development, installation and all. Thereafter, it is started using. So this will be considered as put to use. Put to use. Okay. The overall interest, applicable interest rate being 10%, probably 10 lakhs. 100 lakhs you borrowed on 1/4/24, and using the 100 lakhs you purchased various components for the construction of the plant and machinery, started installing within the factory. By 1st January 25 got installed and it's put for operations also. Now it's generating revenue. Okay. 31st October 25. Okay, this is the due date of filing of return of income, as it requires audit. It requires audit. Out of 10 lakhs, 8 lakhs is paid, another 2 lakhs remains unpaid. Another 2 lakhs remains unpaid. So this 2 lakhs cannot be deductible. This 2 lakhs cannot be deductible. Only 8 lakhs can be deductible. To the extent of payment is deductible. Anything pending cannot be deductible. This is not deductible as per section 43B. So I explained section 43B here. Is that clear? And from the date of borrowing to the date of put to use, how many months are there? 9 months. 9 months interest. So 10 lakhs is for the full year. 10 lakhs into 9/12. What is that? 7.5 lakhs. This 7.5 lakhs will be addable with the cost of acquisition, capitalized under section 43 class 1, actual cost calculation. Then opening WDV value of the asset, add purchases, the value of the asset being 107.5 lakhs. Plant and machinery, if nothing stated, the rate of depreciation being 15%. No sales 107.5, you can claim the depreciation for this at the rate of 15%, but put to use from 1st January 25. So put to use is less than 180 days, so eligible for only half year's depreciation. Come on, tell me. 8.0625. Okay, 625. This 7.5 is added here now. This is as per which section? Section 43B. Out of 8 lakhs, 7.5 lakhs is capitalized. Balance 50,000, you know, can be deductible under section 36 class 1 subclass 3. Can be debited to the P&L account by way of interest. What about this one, sir? This can be deductible as your expenses in the next financial year, not in this year. Up to the date of put to use will be a part of the assets value, capitalized, and you can claim the depreciation on the total value. Cost of acquisition plus interest up to the date of put to use. Because as per section 43 class 1, actual cost includes the interest component up to the date of put to use. After the put to use, that will be considered as your expenses because the asset is ready for generating revenue. As the asset is ready for generating revenue, any expenses related to the asset can be adjusted to the revenue account only by debiting to the P&L account. Provided in case of interest, section 43B will be applicable provided if the interest is payable to whom? To the public financial institution or state financial corporation like or NBFC or scheduled bank or cooperative banks. Okay. In these cases, interest is paid. Only then you can claim. The paid also be within the due date of filing of return of income. After the date, it is not eligible for deducting in this year. Of course, you can claim the deductions the next year, not in this year. You can claim the next year. Is that clear? But if the interest loan is borrowed from your friends and relative or private banks, what happens that interest are, in that case, interest can be debited using a mercantile system. In case of private banks, the overall interest deductible being 2.5 lakhs. 2.5 lakhs can be deductible under section 36 class 1 subclass 3. Clear? In case of private bank. Okay, let me summarize, right? Interest on money borrowed for the purpose of business or professions deductible. If loan is borrowed from bank and financial institution, then allowable on payment basis under section 43B, even NBFC. You can include that. Provided interest on capital borrowed for purchasing of any asset up to the date of put to use of that asset will be capitalized under section 43 clause 1. After that, it will be deductible under section 36 clause 1 subclause 3. Clear? Note. Any doubts here? Hope now you will be able to understand. 3 sections covered. Section 36 clause 1 subclause 3, section 43B, and then section 43 clause 1. Okay. Actual cost includes the interest on amount borrowed for constructing the assets. Up to the date of put to use will be capitalized. Thereafter, you can debit to the P&L account provided if the interest is payable to financial institutions or NBFC and scheduled bank. On payment basis only you can claim. That too, payment should be made before the due date of filing of return. In case of private bank, no need to worry about that. Accrual basis is followed here. Is that okay? Now, some more points. Allowable. Interest on late payment of sales tax. Interest on overdraft facilities. What happens for this, sir? Can be reclaimable as deductions. Interest on loan advanced to sister concern on commercial expediency. Can it be claimable? Of course, it can also be allowable. Okay, sister concern. Interest on loan. But what cannot be allowable? Interest on loan, interest on capital or loan to proprietor. Interest on loan for income tax payment. In case of sales tax payment, the interest is claimable. In case of income tax payment, the interest payment cannot be claimable. Interest paid before the commencement of the business trial run period. You cannot claim this. Okay. 1 second. So, interest on capital or loan to proprietor is not allowable. It's own fund. No, it's always disqualified. Actually, tax, we have 2 tax, right? One is direct tax, another one is indirect taxation. Okay, if you borrow for paying this one or if you are delaying this payment, actually these expenses can be debited in your P&L account. Interest on such payment also be deductible. In case of direct taxation, it is not deductible. Interest on such tax also be not deductible. Because indirect taxation is being a part of the expenses. But direct taxation is not part of the expenses, it's an appropriation. What I earn, finally, a share is given to the government, a share is taken by the owner. The share given to the government may be 30%. It's an income tax. From the profit is going to be payable to the government as well as for the owner. So that's called appropriation. In case of indirect taxation, it's a part of cost anyhow you are going to recover from the customer. Okay, if I pay 100 rupees for my raw material, for that GST 5 rupees I am paying, 105 is my cost. If the 5 rupees is non-recoverable means it's a cost. After that, I spend my own expenses from my pocket around 155. I add my share of profit being 20 rupees, so 175 will be the sale price like. So any of this 5 is recovered? No, it's a part of the expenses like. So in case of indirect taxation, all the indirect taxation, if not recoverable, is expenses debited to the P&L account. While making the payment, if you are delaying, interest on such payment also be deductible. Interest on such payment is also be deductible. Is that clear? Hope you will be now able to understand this one. Any doubts here? But income tax cannot be, it's only appropriation. Anyhow, we'll study that along with section 40 clause A. We have a separate section for that. There we have complete list, but anyhow, just small ideas shared here. So anything related to the indirect taxation and interest on that can be deductible. Income tax and the income tax related interest cannot be deductible. And if the business is not commenced in a trial run basis, in that case, any interest is payable, not deductible. Okay. And the department cannot question the need of borrowing and then the rate of interest. The department cannot question why do you borrow. So means in balance sheet they have cash and bank balance being 50 lakhs and suddenly they have loan borrowed in that current year, say 15 lakhs, and then the rate of interest applicable for this borrowing being 24%. Seems to be foolish, right? 50 lakhs already you have bank balance. Why do you then go for borrowing 15 lakhs? Carries 24% interest on that. There may be question, right? So it's clarified the department has no rights to ask for the borrowings purpose as well as rate of interest applicable for them. They cannot. So they can of course explain, sir, this 50 lakhs for the regular business, for a special requirement borrow. Any of this 50 lakhs I may spend in a matter of 1 or 2 months. Such a way they can give the explanation. Anyhow, the department has no rights to question regarding the borrowings purpose as well as rate of interest applicable for that. Is that okay? These are the additional points. The main point that you have to understand in interest calculation being section 36 class 1 subclass 3 and 43b 43 class 1. 43b, interest if you are paying to 3 institutions, right? Scheduled bank, NBFC, financial institutions. The payment basis will be taken. Right. In case of assets, before put to use, you can debit that to the P&L account. You can debit to the P&L account. Means capitalize that, sorry. Capitalize that, thereafter you can put to, can be debited to the P&L account under section 36 class 1 subclass 3. Up to the date of put to use can be capitalized. After the asset put to use, it can be deductible under section 36 class 1 subclass 3. Clear? So what happens? We have completed 36 class 1 subclass 1 1b. I represents insurance. 2 items are there, bonus and commission. 3 interest. 3 and 3a both are interest. So 3 we have completed. Now I will be moving to 3a. Is that okay? So before I go for the 3a, let me finish off a summary. Section 28 is all about PGBP. Section 29 is all about computation for the taxable PGBP income. Section 30, 31 both are related to plant and machinery and building. Plant and machinery, building and building related expenses. Section 31 is all about plant and machinery and furniture fixtures related deductions. Is that okay? In your balance sheet asset side, first asset being the building, thereafter plant and machinery and furniture fixtures. That's how you can keep in your mind. 28 PGP list. 29 the mode of computation for the income tax purpose net profit. Section 30 building related expenses. Section 31 plant and machinery furniture fixtures related expenses. Section 32 is all about depreciation for all. Okay. Then we go for section 33 AB. AB. Okay. So this is all about tea, coffee, rubber. AB, agricultural business. That's how we can have the term in your mind easily to recollect that. AB represents agricultural business. Tea, coffee, rubber. If you are involving in tea, coffee, rubber business, some amount you deposit for the post requirement. Okay, as per the scheme framed by the tea board, coffee board, or rubber board. The amount you deposited or 40% of such profit, whichever is lower, is deductible as exemption, deductions under section 33 AB. AB represents agricultural business. Then we directly jump to the most important section, section 35, scientific R&D, and 35 AD, specified business, also most important. Section 35D, D represents depreciation. Depreciation of what? Preliminary expenses. Okay, preliminary expenses depreciation will fall under section 35D, can be amortized over 5 years period. So hope now you will be able to understand these sections also. 28 we dealt in detail. Section 28 deals with the list of PGP items considered for the taxability. Section 29 the mode of computation, because trading and P&L account prepared as per the financial accounts, and we have been given the net profit. From the net profit we have to calculate the profit for the taxation purpose by doing some plus or minus. Plus or minus means you may calculate the depreciation as per the Companies Act or financial accounts provisions. Later, by referring the Income Tax Act, the depreciation calculation may be pretty different. You have to adjust those tax differences, means depreciation value differences for the taxation purpose. Similarly, building related expenses, furniture fixtures, and plant and machinery related items can be adjusted here. Section 32 is also all about depreciation, and section 33 AB is all about tea, coffee, rubber board, and Section 35 scientific R&D purpose. Okay, R&D purpose. Section 35 AD specified business. Once again. Now, we'll now start with section 36 class 1 subclass 1 specified employee. Apart from that, we completed section 43 class 1 actual cost and section 38 personal purpose as well as official purpose. If the asset is not wholly used for the official purpose, how can we treat? Apart from that, we completed section 43A. What happens in case of fluctuation, profit or loss in case of forex? You purchase from foreign country, the amount payable sometimes later due to the foreign forex conversion rate. Okay, if you are supposed to pay extra money, how can we handle? We referred that under section 43A already. Apart from that, we have completed 43B also. Payment basis. Deductions is allowable only on payment basis. Okay, this is also we have completed. These are the sections we have covered. And not only that, we completed section 41 class 1 not completed, 2 completed, 3 completed, right? 2 is all about what? Okay, 2 balancing charges. In case of a straight line method of depreciation, after some years the asset may be sold. If there is any gain, to the extent amount already debited, that will be considered as balancing charge, credit in your income statement as profit. And in case of asset sold which was used for scientific R&D purpose, is that okay? That will also fall under this case. These are the cases we have studied. Under 36 section 36 class 1 subclass 1 and 1B both are for insurance. One is for stock insurance, another one is for employees health insurance or health insurance of employee. Okay, insurance of employee. Then we have to understand two items are there: bonus and commission. 3 is all about interest, and 3A is all about zero coupon bond. This is also interest component. Like, that's how you can understand all these things as a set by set. Okay, so let me now cover the zero coupon bond in detail. Okay, then after the break we'll continue the rest. Most probably I may complete all these PGP provisions by today itself along with the comprehensive illustrations. Clear? So let's start with section 36 class 1 subclass 3A, zero coupon bond. Zero coupon bond is nothing but company A issues the debentures, debenture holders. Okay. The consideration for this being the debenture face value being 100, issue price being 40, duration being 10 years. Okay. Clear. Is there any interest payment? No interest is payable. If the debenture holders purchases it for 40, later on sells it for 100, the difference between these two 60 will be their interest component. So, this 60 rupees is for 10 years. Per year, 6 rupees is considered as interest to be debited to the P&L. Per year, 6 rupees. Provided if the debenture issued on first 10 years means 120 month, am I right? 120 month. If the debenture issued on 1st July 2025, so 2024, for the previous year 1/4/2024 and ends on 31st March 2025. Okay, 1/4/2024 to 31st March 2025. Clear. Now 100 minus 40 is the interest component for 120 month. Then what about the interest per month? 50 paise, am I right? In this year, how many months are over? Already 3 months over. So remaining 9 months, for 9 months per month 50 paise, 4 rupees 50 paise will be the interest under section 36 class 1 subclass 3A. Subclass 3A. Clear? 4 rupees 50 paise. If the company issued 1 lakh debentures, 1 lakh into 4.5, 4.5 lakhs will be the deductible amount. Is that clear? The topic is very simple. Calculation is very simple. Only one minute adjustments you have to carry on. What is that? It is clear, right? One extra adjustment, 1/4/2025, 31/3/2025. Okay, this is 1 year. This is 1 year. 1/4/2024 to 31/3/25. This is 1 year. This is 1 year. Is that clear? Suppose 1/4/24 to 31st. The debenture issued on 16th June. Actually, 8 months and some days. How many days are there? In July, 28 days. Sorry, 31 days. 15 days already over. Okay. 31. 15 days already over. Balance 16 days is there. If the part of the month is having more than 15 or 15 and above, will be considered as 1 month, 1 more month. So 9 months. This is 9 months. Similarly, after 20 years, it ends on which date? 15/7/24. I mean 15/7. The maturity date being 15/7/2034. Am I right? 10 years after. 1/4/2034 to 31st March 2034. In this, how many months are there? April, May, June. In July, 15 days is there. That will be considered as 1 extra month. So here 4 months. So now how many months we have? For this year 24-25, we have 9 months, and 25-26 to 33-34, the last of this year. How many years are there? Almost 9 years. 9 years. 9 years into 12 months. How many months are there? Come on. 108 month. Apart from that, the year 34-35, how many months are there? 4 months. If you add up all this month, how many months are there? 121. Naturally, rather than 120, you will get 121 month. Is that okay? 100 minus 40 divided by 121. Then depreciation will be 0.0 may be asked. That's why I explained this one. Otherwise, this sum is very simple. The sum is very simple. See, this discount on zero coupon bond. This will be called discount on zero coupon bond. Discount is nothing but interest. Zero coupon. Zero coupon means it carries no interest. Coupon usually associated with the interest. Okay. Coupon means interest. Zero coupon means interest is zero. So how can we issue the shares without any interest? It means the interest component will be offered as a discount. Applicable for infrastructure capital company or infrastructure capital fund, public sector company, scheduled bank issuing zero coupon bond which are notified by the central government. Applicability. Life of the bond being 10 years to 20 years. Benefit, no benefit before the maturity redemption date. You don't get any benefit during the period. You purchase it for 40, on maturity you will get 100 rupees. No other benefit will be enjoyed. The difference between redemption value and issue price. Redemption value 100, issue price being 40. The difference between these two is the discount, otherwise equated with the interest. That deduction can be claimable, this discount over the life of the bond of the calendar. Bond in calendar month. Bond in calendar month. 15 days and more will be considered as one calendar month, and TDS is not applicable. TDS is not applicable. These are the small provisions you have to understand. Clear? Now, now, Reliance Infrastructure Limited, an infrastructure company, issued zero coupon bond on 1924. 1924. Previous year starts with 1424 and ends on 31st March 25. 50 rupees, face value 100. Redeemable at par after 120 months. So from this to this is redeemable by 125 months. Means 100 rupees, issue price 50. The difference between these two 50 rupees will be your discount amortized over 125 months. Then per month how much will be come on 0.4. So this can be amortized over how many months? 125 months, and in this 7 months into per month 0.4, number of bonds being 50,000. If I multiply all these things, then what is the ultimate value deductible? 1,40,000 rupees. So the date 1924, automatically exactly the day 1, when it is being 16th of any 31 days month, then there will be trouble. There will be trouble. Else the calculation is very simple. 100 rupees, issue price 50. The difference between these two 50 rupees amortized over the lifespan. Usually the bond will have life anywhere between 10 years to 20 years. More than 10 years and up to 20 years. Is that clear? That's all about section 36, class 1, subclass 3A. Any doubts here? Yes, make note of it. So we have completed section 36, class 1 and 1A. 36, class 1, subclass 1, 1B, 2 and 3 in the earlier class, 3A also. Now we have to go for 4, 4A, 5 and 5A. Four aspects are going to be covered here. Now, so you know that PF is contributory amount from the employer as well as employee side. That aspects is going to be covered here. If the employer makes any payment for the employee's PF account and gratuity payment, that will be deductible in their own P&L account as an expenses. Is that okay? See here, employer and employee. As employee rendered service to the employer makes a payment like salary and all, say 1 lakh per month. Apart from that, employer deposits for employees benefit in RPF account. Okay, RPF account. Not only RPF, maybe NPS scheme. NPS scheme and gratuity fund or gratuity fund. Okay, so I give the list here this way. PF, NPS, gratuity on behalf of the employees benefit. Apart from that, employer collects the money from employee for his contribution. This is all about employee's contribution. Probably 10%, 0.1 lakh. Collected by the employer and deposited in his own account. In his own account. The PF amount being say 10,000, NPS being 5,000 rupees, gratuity contribution, okay, maybe around 5,000. And for employees contribution, around 15,000 is collected from the employee and deposited. 15,000 rupees. Now in employer's P&L account, under the employee cost, apart from salary, probably salary also on expenses can be debited, and employer's contribution for PF, NPS, gratuity, all can be debited. In case of employees contribution will be income on collection. On deposit into the concerned account will be expenses. Employees contribution on deposit will be the expenses. Is that okay? These are the points you have to understand. So salary being 1 lakh per month, PF being 10,000, NPS being 0.05 and gratuity being 0.05. But only in case of NPS we have a separate different dealing. As well as the employees contributions collected and deposited, we have the separate dealing. We'll see that later on. Let's see the PF, NPS, gratuity, all the three can be deductible only if it is paid before the due date of filing of return of income. Means section 43B will be applicable. Section 43B will be applicable. If it is not paid, then it is not deductible. If it is not paid, it is not deductible. So, as all these expenses, all this payment for the employer's benefit will be debited, as it's payment for the employer, also an expenses apart from the salary. Okay. So, this employer's contribution to PF account will be under section 36, class 1, subclass 4, NPS being 4A and gratuity being 5. These three sections are dealing the same pattern like, okay. If these amounts are deposited within the due date of filing of return, then you can claim the deduction. Else you cannot claim. In case of this one, employee's contribution should be deposited, only then you can claim the deduction as per section 5A. But main thing to be noted here is, it should also be deductible only if it is paid, payment basis, but not as per section 43B. For this, section 43B is not applicable. Section 43B is not applicable, payment basis. And which section is applicable? So here the term 5A itself specified properly. Payment should be within the due date for such payment as per the Act. Such payment as per the Act. Okay. PF Act. PF Act says January month PF amount should be deposited within 15th of February. Similarly, March month PF should be paid within 15th of April. So, if the amount collected from the employees for his contribution should be deposited within the due date as per the PF Act, only then claimable as deduction, else not deductible. So, this payment is totally different. Is that okay? This payment is totally different. So, from this it is clear, when I use the term payment, it may be three different dimensions. When it's all about municipal tax, the payment should be within the last date of the financial year, 31st March. In case of the payments as per section 43B, you have to make the payment before the due date for filing of return of income under section 139 class 1, which is 31st July as well as 31st October in most of the cases. Is that okay? But when it's all about collection of the employee's contribution and deposited, okay, if it is collected and deposited within the due date, don't show this at all. You don't show in your books at all. But if you have collected but not deposited, then it will be income. Collected and deposited, then it can be subtracted, but the deposit should be within the due date mentioned in that concerned act. Okay, usually 15th of the next month. These are the three things. These are the four things. Okay. So, employer's contribution of PF and employer's contribution for NPS and employer's contribution for the gratuity. 4, 5, 4A and 5. 5A is all about employer's contribution. Clear? Now, one more condition that you have to understand is all about for NPS. In case of NPS, maximum contribution should be only 10%. You know that PF should be 12%, right? Similarly, here it should be 10% only, not more than 10%. If it is more than 10%, that cannot be debited in your P&L account. Only to the extent of 10% is deductible. Hope now you'll be able to understand. Let's now brief all these things. Let me first finish off an illustration all about NPS scheme. 36 class 1 subclass 4A 80 CCD deduction. Okay. Here you can apply the section 43B, paid before due date for filing of return of income. Apart from that, deduction is restricted to only 10% of salary. Salary in this case is all about basic plus DA forming part of salary. Okay. Now, if it is more than 12%, that is also disallowed under section 40A class 9. Okay, if you are depositing that more than 10%, that beyond the 10% is disqualified amount, no. So, as per section 10A class 9 also be considered as disqualified. So, nothing can be deductible. We will see section 40A class 9 later on. So, there we have set 40A class 2, 3, 3A and 7, 9. So, those are the sections we are going to study after this 40. Okay. Now, you remember that as per section 40A class 9 also, the excess amount beyond 10% is also be not allowed, disallowed. Let's see. Singer Limited contributes 20% of basic salary to the account of each employee under a pension scheme referred to in section 80 CCD. 80 CCD is a section for a national pension scheme, new pension scheme. Okay. As per the NPS scheme, employer should also contribute, employee should also contribute from his own salary for his own retirement benefits, right? We'll study ATCCD chapter detail along with the deductions chapter. Here you refer that section alone. Dearness allowance 40% of the basic salary and 40% of its forming part of the retirement benefit. So, salary being the basic salary of the employee aggregates 20 lakhs. Okay. Now, what happens? DA being 40% of salary, 8 lakhs. Out of that, 50 percentage being forming part of salary. Now, what about the NPS? NPS, employer's contribution. Employer's contribution, how much is that? 20 percentage of the basic salary. 20 percentage. How much? 4 lakhs. But as per the act, what says? Okay. Restriction, limit. Limit being 10 percentage of salary plus DA. Basic plus DA forming part of salary. Basic plus DA forming part of salary. Okay. So, 20 lakhs basic, DA forming part of salary. Out of 8 lakhs, 50 percentage. 4 lakhs will be taken. So, 24 lakhs. On that, 10 percentage will be calculated here, 2.4 lakhs. Is that okay? 2.4 lakhs. Only 2.4 lakhs is allowed. So, this 1.6 lakhs will be considered as salary income. In PGBP, profit and loss account, you can debit salary 20 lakhs, DA 8 lakhs, NPS only 2.4 lakhs is allowed to be debited. Only 2.4 lakhs is allowed to be debited. The excess 1.6 lakhs isn't it? That will not be qualified to be deductible. Even by applying section 40A clause 9 also be disqualified. Right. Now, compute the amount of deductions under section 36 clause 1 subclause 4A if the basic salary of the employee agreed. So all the things are there. Okay. If so, what extent? So already I just explained all the illustration here. So only to the extent of 10% of the salary. Salary here means basic plus DA forming part of salary. To that extent can be debited. Beyond that is disqualified. This will not be deductible at all. If it is deducted, then that will be now adjusted. You have to remove it. So that's how we can calculate. Clear? It is not employee's point of view. It's all about the company's point of view. As per the company's point of view, these items will be deductible expenses. So out of this 4 lakhs, only 2.4 lakhs is deductible. Balance 1.6 lakhs not deductible. Right. Now let's see all the points one after one. In case of section 36 clause 1 subclause 4 is all about RPF and approved superannuation fund. Provided it should be paid before the due date of filing of return of income. 43B is applicable. And 4A is all about NPS. Okay. Pension scheme under section 80CCD. Here 43B is applicable. Apart from that, deduction is restricted to only 10% of the salary. Salary means basic plus DA, and section 48 clause 9 is also be applicable here. As per that provisions, this excess contribution of NPS is disallowed to be deductible. Now 5 is all about what? Gratuity fund. Employer contributes for the gratuity fund. If it is contributed for employee's benefit, also can be deductible only if it is paid before the due date of filing of return of income. Section 43B will be applicable. Now, section 36 clause 1 subclause 5A. This is nothing but sum received by the assessee from any of his employees. Not income. Not income. Okay, this is not income. This is not income. As well as this is not going to be deductible. Okay, this is not income but not deductible. Provided, what's the condition is there? This deposit should be made as per this provision. If it is not satisfied, then automatically it becomes income. It becomes income. Is that clear? See here. So, any amount you receive from employees is not considered for the income purpose for the employer, but provided such sum is not credited to the employee's account. Okay, it should be credited to the employee's account. If it is not credited, then automatically what happens? It becomes the income as per section 2 clause 24 class subclass 10. And the amount collected, okay, is not credited. It's not credited means in your P&L account, the amount you collect from the employee may be 10,000 rupees, employer to employee, and here 10,000 rupees is deducted and kept by the employer. This amount should be debited. So, not required to be credited, provided what? Paid before the due date for payment as per such act. If it is paid within the date. If it is paid within the date, it will not be income as well as it is not expenses. But amount collected but not deposited within the due date as per the relevant act, then automatically what happens? The employee's contribution received from employee will be the income under section 2 clause 24 subclass 10. Okay, clear? Hope you will be now able to understand this logic. The amount collected is deposited, then both will not be shown in our books, but collected but not deposited, then this will appear, this will not appear, only being income. So the income will be higher, we have to pay the higher tax. This one is all about totally different. The payment in this case is all about payment should be within the due date as per the concerned act will be taken here. Usually, which is nothing but 15 days from the end of the month. January PF will be deposited within 15th of the February itself, right? So amount of 25,000 received from the employee of the nursing home as contribution towards provident fund for the month of March 2025. So in P&L account, any amount collected will be considered as income, employee's contribution for PF. Okay, section 2 clause 24 subclass 10. It's not required to be noted or quoted in your examination. 25,000 and paid to PF commissioner of is 15,000 on 15th April 2025 and balance 10,000 is on 25th April. So this one out of 25,000, 15,000 deposited within the due date. If the amount is deposited within the due date, okay, deposited into the account, how much? 15,000 is deposited within the due date. To the extent amount already deposited within the due date for such payment can be deductible under section 36 class 1 subclass 5A. As per this section, it can be debited. So from this, it is very clear, to the extent not deducted or not deposited, this 10,000 rupees deposited only on 25th April, this 10,000 will be taxable income. That will increase the income. So you have to show this 10,000 being your income in your books. Is that clear? So all the 4 clauses explained with a small chart here itself. So this chart is more than enough to understand all the 4 blocks. Clear? If it is clear, text me. We'll move on to the next one. Make it faster. Online students, respond me. Now, let's move on to the next section. Section 36 class 1 subclass 7. What happens in case of bad debt, sir? In case of bad debt, that bad debt can be debited to the P&L account. Okay. In your trading and P&L account and balance sheet. What happens, in case of sales, that to credit sales, you post here as sales being 1000 rupees. Okay. That becomes a part of debtors in balance sheet. Clear. Later on, one of the debtors from whom we have to recover 200 failed to pay 200 rupees. That will be called as bad debt. Hereafter, debtors balance being only 800. In that case, you can debit that 200 rupees in P&L account. Bad debt can be debited here. Bad debt can be debited here. Under what section? Section 36, class 1, subclass 7. Clear? Subclass 7. After debiting the next year, if you recover the amount, that will be considered as your income. Later on, if you recover, that will be income. Remember one more point. I paid 1 lakh rupees as an advance for purchasing a plant and machinery. What is journal entry? Advance for plant and machinery to bank. Advance will go to the balance sheet asset side until asset is procured. That appears as an advance. So, advance for plant and machinery purchase 1 lakh. Okay, 100,000. Later on, this 1 lakh seems to be non-recoverable. That part is abscond. We could not recover the plant and machinery. We cannot recover the amount also. So this will be now subtracted. Non-recoverable. Non-recoverable. Can I debit this 1 lakh rupees in P&L account? Can I debit this 1 lakh in the P&L account? Okay. As bad debt? Means of course not. Of course not. You cannot debit this. Of course not. Clear? To claim this being the bad debt, earlier to that such income should be considered as income in your P&L account. The sales is considered as income and credited in the P&L account. Later, that amount not recovered, then bad debt is acceptable and debited to the P&L account. But in case if you are paying any advance for procuring the asset, it's not credited in the P&L account, shown as an advance only in the asset side. Later on, that advance non-recoverable, then it is a capital receipts and payment. Like capital receipts and payment will not be shown in your trading and P&L account. So it will not be adjustable. It will not be adjustable. Clear? Now, in the next financial year, okay, what happens in case of next financial year? We found that original debtors being 1000, bad debt, probably one of the debtors A failed to pay 200. We thought we can recover 800 rupees. We can recover 800 rupees. This was shown as bad debt and claimed as deduction under section 36, class 1, subclass 7. Clear? 36, class 1, subclass 7. Any clear? But later on, what happened, for the entire 800 rupees, we collected only 750 rupees. How much we collected? Only 750. Final payment like 1000 rupees recoverable. We confirm that 200 will not be recoverable. Balance 800 we expected in the next financial year. Out of 800, only 750 collected. What about the remaining 50 rupees? The remaining 50 non-collectible at all. This remaining 50 is non-collectible at all. This 50 is called bad debt. Will not be recoverable hereafter. This will not be recoverable at all. Bad debt under section 36, class 1, subclass 7. Clear? Suppose if we collect 900, what happens? 900, what happens? Out of 1200 not collectible, the same debtor now comes to me, sir, earlier I didn't pay now I have the money, I can pay. I want to build the relationship. So he settles that money today. So he makes another 100 rupees also. Now we recovered 900 rupees. Then what is journal entry? What is journal entry? Bank account debit to debtors. Debtors balance is how much? 800. But how much you collected? 900. The excess 100 rupees you collected, will be deemed income. How it is advance? Advance means you have to repay that later. So this is nothing but bad debt recovered. Bad debt recovered. Bad debt recovered will be named as deemed income. So here the additional 100 rupees is called deemed income. Deemed income falls under which section? Which section? Deemed income is set of income. I told you now. What's that? Hmm? Section 9. That's deemed to occur or arise. Here. Notional income. What are they? 41. Section 41, class 3. 3 over here it's 4. Okay. Can you recap? Section 41, class 4. What is 2? What about section class 2? What about class 2? Balancing charge. 3. Sale of scientific means asset used for scientific R&D purpose. To the extent amount already claimed is deduction. And now we claim the bad debt as being expenses debited, and later if I recover, that will be income under section 41, class 4. Is that okay? So by studying all these things, you can complete what? Section 41 completely. 41 class 1 we'll study later on. 2 already over, 3 also over. Now 4 is completed. Bad debt recovered is completed here. 4A and 5 not required for the CA inter. Okay. Hope you will be now able to understand all these concepts. Now, deductions for bad debt written off conditions. The bad debt should be incidental to the business. Okay, incidental to the business. This will be incidental to the business. Am I right? This should be incidental to the business, but it is not related to that. Is that okay? If you are advancing some money to somebody else, but you don't get it back, advancing will not be your business nature. But if I am being the banker, advancing loans and advances my business. If that money is not collected, then it's a bad debt. But if I'm not involving in finance activity, but if I'm advancing to one of my sister concern or some friends, if I didn't get that, that will not be considered as bad debt deductible under section 36 class 1 subclass 7. Okay. So listen here. Money lent in ordinary course of banking or money lending is allowed. Second point, bad debt deductible only if such amount is included in income. So here this one was already included as income, but here it is not included. So it is not deductible. This one is deductible. Clear? Credit sales. Considered as income on sales, and any amount not deductible means recovered, later on named as bad debt and recovered. An advance is given for purchasing assets, not an income, later on not recovered, or the advance becomes non-recoverable, is not related to your business. So though it is a business capital in nature, not deductible. Even loan given by whom? Not by the lending company. So not by the banks or money lender. It's not your regular activity. But if you are lending, that is not income. Lending is not your income. If that money is not deductible, not recovered, then it's called bad debt, non-deductible. Clear? And third one is written off in the books of accounts, must. So you have to write off the name, yes, amount not recovered. So you have to subtract and show this. Don't just create the provision, sir. Yes, amount may be doubtful, sir. We can create a provision and keep the amount as it is in the returns. No, you can't claim the deductions. You have to write off. His name should be completely closed. If it is not so, you cannot claim. Except where income not credited as per AS but recognized as income as per ISTS. So this is not required for your learning purpose here. Just to understand your logic. ICDS in the earlier class also I explained and noted income computation and disclosure standards. If income computation and disclosure standards says that it can be debited, then of course you can debit because the standard given by the income tax department. So no need to worry about that. Deductible only if the business is continued during the previous year. Business discontinued, then you cannot claim. Business discontinued means you cannot claim. And deductible even the successor of the business. If the business is transferred to some third party as a whole, and for him also the bad debt is claimable as deduction, sir. And section 41 clause 4 is all about a recovery of bad debt. Okay, even the business is discontinued 5 years later, one of the old debtors where we write off his own dues as a bad, now he gave me the money. I told him, sir, I already closed the business. So what? I'm giving the money. Don't you want to take? So we will be always interested to take the money. So we'll get it money immediately. So if you are getting it money, even though you don't have the business in later period, that will be considered as your income only under section 41 clause 4. Okay. So with that, all the provisions are over. Let's now try to solve this illustration. Singer, a trader, has an amount of rupees 50,000 recoverable from A for the goods sold. Singer claimed deductions allowed rupees 20,000 under section 36 class 1 subclass 7. So debtor, whose name being A, how much we have to recover? 50,000 rupees. In the previous year, we came to know some amount will not be recoverable. So we claimed the deduction under section 36 clause 1 subclass 7 related to non-recovery of the amount called as bad debt. This amount being 20, if I subtract 20,000 from 50,000, 30,000 we thought to be recoverable as well by balance sheet. For the same in the previous year, for the same amount, this was already claimed. This is in the previous year 23-24. During the previous year 24-25, Singer recovered from A as full and final settlement only 20,000. Out of that scenario A, we collected only 20,000 rupees and stating that this is the final amount we can recover. We thought we need to collect around 30,000 rupees. We collected only 20 and no more amount is recoverable from him. This will be the only amount. First, only full and final settlement like we collected. So we collected 10,000 lesser. Any amount we collected less than the recoverable amount will be called as bad debt, claimable as deduction under section 36 class 1 subclass 7. Okay, this is for the previous year 24-25. In 23-24, we already claimed bad debt 20. In this year, we confirmed that another 10,000 not collected. So this is also considered as bad debt not recoverable, deductible under section 36 class 1 subclass 7. And scenario B, 30,000. If 30,000 rupees collected, no problem. What we shown in our book, we collected, so no problem here. Okay. In case C, we collected 45,000. What does it mean? We need to collect only 30, but we collected more than the amount shown in the books. The higher collection 15,000 is nothing but earlier we collected, we deducted as bad debt as estimated one from the government under section 36 class 1 subclass 7. This amount is collected, right? As the bad debt earlier is collected, it's called bad debt recovery. This is called bad debt recovery. This will be the deemed income under section 41 class 4 for the previous year 24-25. Is that clear? If you have any doubt, you can ask me, else we'll move on to the next proviso. We'll try to finish up to 37, 38 before the break. After the break, we'll continue for the specific disallowances under section 40 class A. Okay. Make it faster. If it is clear, text me. Now, section 36 class 1 subclass 9, all about expenses related to family planning promotion expenses. Usually this will be available only for companies. For what? Promotion of family planning among the employees. Any expenses you incur for promoting the family planning among the employees can be deductible. Of course, this will be available only for the company SSC. If it is not being the company SSC, of course, they cannot claim this. And the family planning expenses can be categorized into revenue and capital expenditure. In case of revenue expenditure can be deductible. In case of capital expenditure, 1/5 will be deductible in the first year and the balance 4/5 will be deductible in remaining 4 more years. Okay. So what are the expenses you do? So in P&L account, family promotion, family planning. Okay. Promotion of family planning expenses. Revenue expenditure, say 1 lakh. Capital expenditure for 5 lakhs. And the net profit being 50 lakhs. This is how they might have shown. But actually, this one is allowed, no problem. But this one, only 1/5 is allowed, balance is disallowed. So how can you prepare? Net profit as per your financial reports 50 lakhs minus disallowed amount. Disallowed. How much is disallowed? In that capital expenditure 5 lakhs, 4/5 is disallowed. So only 1 lakh is allowed. So 54 lakhs. This is addable, right? 54 lakhs is the taxable PGBP income. On this only you have to pay the tax. Next year, again you can claim another 1 lakh. Okay. Then next year, another 1 lakh, and next year. Such a way you can carry forward. Right. Clear? So revenue expenditure can be debited, capital expenditure can be debited over the 5 years period, equal amount. Right. Now what happens in case you don't have the net profit, you have loss, 2 lakhs loss. What can we do, sir? In case of loss, how can we adjust this? In case of loss, this 1 lakh is allowed, in this 1 lakh is allowed. Okay. In case loss being 10 lakhs. Okay. Only 1 plus 1 lakh, 2 lakhs is allowed. 2 lakhs only allowed. But there is a loss, then how can we treat this, sir? This can be treated as unabsorbed depreciation, like unabsorbed depreciation. In case of unabsorbed depreciation, how do we calculate? We studied that along with section 32, especially provision 2, the mode of set off and carry forward. The business has loss. The loss is categorized into loss due to what? Depreciation, loss due to business. The loss due to business can be adjustable in the subsequent year in 8 years. But depreciation can be adjustable any income, infinite period. The same logic will be applicable for this. As well as the same logic is applicable for scientific R&D purpose also. I missed to explain by the time. So the similar logic will be applicable. The depreciation like will be applicable for the family planning capital expenditure and revenue expenditure, scientific R&D purpose expenses, right? Hope you will be now able to understand this logic along with. So unabsorbed family planning expenditure can be set off and carry forward as unabsorbed depreciation like. So if you are strong with unabsorbed depreciation calculation, this part is similar. Clear? Now 5, 15, 16. Okay. These two are deductible. Security transaction tax, commodities transaction tax. Okay. Provided these two are deductible if securities commodities are held as stock for business. Okay. Now you can buy the shares and securities. You can buy and sell. Okay. So buy and sell what? Shares. Buying and selling of the shares in the market, stock market. Are you doing this as business, or I hold it for a temporary purpose? Sometimes later I may sell it off for my capital appreciation or dividend earnability. My intention in this case is not to do the business, but hold this as my savings. Then it is considered as capital gain, capital asset like. Okay, is it treated as my day-to-day stocks or asset? If it is treated as stocks, and this will be considered as PGBP. If it is considered as my asset for my lifetime requirement, maybe for lifetime savings or backup, like in that case, any profit or loss on selling the capital asset will be called as capital gain. Capital gain. Here in PGBP, in P&L account, sale value of securities may be 100,000s. For that, you may pay the security transaction tax. Probably 1000 can be debited here under section 36, class 1, subclass 15. You can debit this. Clear? Clear? Hope you will be now able to understand. Buying and selling of shares will be called as. Are you able to understand? No. Hmm? Buy and selling. uh, Are you able to understand? No. There. Okay. I thought you were sleeping. Yes, sir. Now and then. Huh? So buying and selling of the shares. Buying and selling of the shares. Clear. As your business activity, if you are doing, then it will fall under PGBP income. Okay. In your PGB, while preparing the P&L account, sale value is credited and cost for security transaction tax can be debited. Apart from that, other purchase cost and brokerage, whatever it may be, you can debit all these things. No, sir, I'm not going to consider that being my business activity, sir. I'm going to purchase this for my savings. Like I treat this being the asset. Sometimes holding. Later on, you plan to sell it. So while selling, you get any profit and loss. That will be called as capital gain. That will be called as capital gain. Is that clear? So in case of capital gain, sale consideration 100 minus security transaction tax, how much? 1. Remember, this is not allowed by the time. This is not allowed by the time. If you are considering this being the PGBP, security transaction tax is deducted. Same if you are considering this being capital asset, then automatically what happens? STT cannot be deductible. If you are deducting this as expenses, your profit will go down. Will you be happy or not for reducing the profit? Okay, yes or no? You will be always happy to reduce the profit. So for the taxation purpose, for other reason you will show differently. If you're supposed to get married, if somebody will, what about the groom or bride's salary? 2 lakhs, 3 lakhs. In case of tax department, what's your salary? Only 10,000, sir. So all these things happening. Similarly here, the same happens here. Okay, capital assets, capital assets. If you are considering this being the capital assets, STT cannot be deductible. If it is considered as PGBP, of course, you can claim the deduction for STT, provided if you are showing this as a PGBP, the tax rate being 30%, regular tax. If you are showing this as a capital asset, 20% will be the tax rate. So you will be enjoying either this way or that way. Okay. So lower tax by claiming lower deductions. There, more deductions will be available, but tax will be heavier. So how can I classify this, sir? Usually, stock market transactions, no, we consider this being the capital assets. Capital transaction only comes under capital gains. Rarely somebody will show this and classify that I'm doing this as a business and prove, and you can claim that one also. If you are claiming that buying and selling of the share being your trading activity is a business activity, you can claim the STT. Buying and selling of the shares, leave that. Rather than buying and selling of the shares, sometimes you can buy and sell the commodity. Okay, commodity. For that, equivalent to STT, we have to pay one more tax called CTT, commodity transaction tax. The CTT is agricultural business. Okay, in case of agriculture produce, this CTT is exempted. Okay, that STT or CTT are deductible if securities or commodities are held as stock for business. Else you cannot claim. So with that, we have completed section 36 completely. Come on, list down all the sections. Section 36, class 1, subclass 1, 1B. This is all about insurance. Insurance for what? Stock insurance for employee, the employee's health. And 2 is all about what? Bonus and commission. And 3, 3A is all about interest and zero coupon bond. And then 4, 4A, 5, 5A. RPF, PF and superannuation fund. RPF. This will be employees contribution. Employees contribution for PF. 7 is all about bad debt. 7. 9 is all about promotion of family planning. revenue expenditure as well as capital expenditure. Capital expenditure amortized over 5 years period. Apart from that, we have CTT as well as STT. With that, section 36 class 1 for CA Inter is over. What about CM Inter, sir? Still we have some other classes also, right? I don't know why they keep all those sections. All these things are maybe taken from the Keelady. Oil excavation, some sections might have been seen and included in the topic. Those are not anyhow going to be used for so many most of the cases, right? Shall I move on to the next one? Section 36 specific deduction is over. Let's now move on to the next one. What's that? General deduction. General deductions. Expenses deductible which are not covered under section 30 to 36. We have studied a specific expenses to be deductible under section 30 to 36. Apart from that, some other expenses also related to the business where it is coming under general category. It is being the revenue expenditure related to the business purpose. Okay. And in case of a business contract, there is a violation and you pay the fine and penalty as per the business contract, deductible. Indirect tax and interest on it, deductible. Already told you, know, in case of indirect taxation, interest on it, deductible. In case of income tax, interest cannot be deductible. So these are the 4 lists I have given here. Revenue nature expenses, that too related to the business, and business contract. What is called business contract? Probably A may say to B, I will supply the requisite commodity within a month's period. And B also says, okay, I will accept. Provided you have to submit, you have to supply within 1 month. If it is delayed, then it is unwanted product for me. Okay. Then A also committed. But as per the statement given by A, could not supply within 30 days. So he supplies in the next month. 10 days delay. Okay, immediately B says, I was in need of that only in the last month, not in this month. I don't want to take up. Else, I will take up, but I will charge a penalty. So immediately pay demands a penalty or pays lesser amounts, or 20 or 25,000 may be lost. Like that is called fine or penalty payable because of violation of the business contract. That can be debited. Similarly, indirect taxation related interest and indirect taxation can be debited. Then what could not be deductible? As revenue expenses deductible, capital expenses not deductible, business expenses related to your business deductible, personal expenses cannot be, fine related to the business contract deductible, but fine related to the legal violation not deductible. If you are violating any legal requirement and if you are paying anything, that fine will not be deductible. So in case of traffic violation, you are paying, okay, overloaded with your lorry carriage, goods carriages. So for that, the traffic violation is there, you pay the penalty. That penalty cannot be deductible. And direct taxation and related interest will not be deductible. Hope you will be now able to understand. Now, notional expenditure, any anticipated losses or expenditure not allowed to be deductible. Only confirmed expenditure can be deductible. Like anticipated loss is nothing but provision for doubtful debts. In case of provision for doubtful PDD, provision for doubtful debts, not confirmed one, so you are not allowed to debit in your P&L account. As per the P&L account provisions, what you do in financial accounts, PDD will be debited. But for the taxation purpose, of course, that should not be debited. Only on confirmation of the bad debt can be deductible. Legal expenses for direct tax consultancy and filing is very important. In case of direct tax consultancy and filing, the legal expenses allowed. Legal expenses is allowed. Clear? Hope now you'll be able to understand this part. Section 37 class 1. Expenses deductible which are not covered under section 30 to 36. Some list of expenses are here. So for additional learning, in case of medical practitioner getting any freebies, illegal in India or outside India, so not deductible. Okay, some pharma company, no, pressurizing the doctors to recommend their products. Okay, for that the pharma company will honor them lots of gift even free medicines, even foreign trip and all. That is actually illegal. That's actually illegal. Automatically, what happens now? The freebies given by the pharma company cannot be debited in the P&L account. In the P&L account, sir, I will gifted so much of money to the doctors for promoting our medicines. If you are showing this, automatically there will be legal violation. You may be under jail also sometimes. Any of that expenses cannot be debited. That expenses cannot be debited. Premium for keyman insurance policy deductible. Okay, any premium paid will be deductible. Okay, so XYZ company, limited company, and X being the key man, who is being the key man. And with the LIC company, on his name, XYZ made a payment for the premium. If anything happens to X, automatically what happens? LIC releases the compensation. If the compensation received to the family of X are surviving X, it may be released, or a portion may be given to the XYZ, or both complementary. Okay, some portion for the company, some portion for the employee, or fully for employee or fully for XYZ Limited. Doesn't matter. If it is fully for the employee, then it will be salary income. Already we studied profit in lieu of salary under section 17 class 3 we have studied. In case if the amount is received by the company itself, then it will be PGVP under section 28. Under section 28. And the premium paid by XYZ company will be considered as expenses. In P&L account, premium for key man insurance policy can be debited. Okay, under section 37, general clause. And any compensation received, including bonus from key man insurance policy, okay, will be income under section 28. Will be income under section 20. The same income is received by the employee, it will be shown as salary in his own personal income. Clear? And payment to an IT advisor to conducting appeal before ITAC, Income Tax Appellate Tribunal. So when there is a dispute between assessee as well as tax department, can be resorted through court. First of all, the lower level settlement will be done in tribunal. If the tribunal decision is not satisfactory, we'll go for the High Court and Supreme Court also finally. Right, the first level. So I got a query from the income tax department. I cannot stand myself to answer their queries as I'm not expert in that. So they put some chartered accountant, cost accountant, or company secretary also can represent on behalf of him. Even advocates goes and represents on behalf of the client and defending the case. And if he gets any fees, that fees can be debited in your payroll. Section 37. Payment to an IT advisor. Fee for tax. Late fee. If in the form of penalty, not deductible. If not in the form of penalty, deductible. Okay. Fee for tax. Sometimes it may be named as fee. What is it? Fee. Okay. Though the name may be fee, but this fee may be violation of any legal provision, so you have to pay this. Then it seems to be penalty like. Sometimes it may be registration like. Okay, I am forming a company. For that company formation, I have to pay the registration fee. Okay, while making any tax applications, for that I am paying any registration fee. Those fee is not penalty in nature. As it is not being penalty in nature, can be deductible. Okay, this cannot be deductible. So you have to file your return of income on 31st July or 31st October. If you don't file, delay that, you have to pay a penalty. That penalty is usually called late fee. Term is late fee, but because of the violation of the payment date, as it's a legal violation, that fee will be considered as the late fee is considered as penalty. Instead of that, GST registration. For the GST registration, if I am making any payment, okay, for GST registration, if I am making any payment, and there's a fees for that also, okay, if there's a fees, okay, that fees is called as registration fee, okay, that amount can be deductible in your P&L. Hope you will be now able to understand the fifth point. So we have completed point number 2, point number 3, point number 4, point number 5. In case of shares and debentures, related to share and debenture, we may pay sometimes issue expenses, forfeiture expenses, and buyback expenses and all. Now the question is, what about that issue expenses? Can it be debited in the P&L account or not? Okay. In case if the expenses seems to be revenue nature, can be deductible. If that seems to be capital nature, that cannot be deductible. How can I decide this being the capital nature or revenue nature? Very simple. Because of issue of shares, capital of the company is increasing. So capital of the company is increasing means what does it mean? Capital employed is increasing, not related to your P&L account. So any fees you pay related to that only no capital expenditure will be considered as capital nature. For example, expenses for IPO, further public offer, or right issues. Due to these three reasons, authorized capital is increasing. Okay, because of these three reasons, authorized capital is increasing. This is being the capital receipts. Expense related to the capital receipts also being the capital expenditure. So not deductible. Not deductible. Okay. Expenses for IPO where allotment was cancelled due not deductible. You called for a subscription of 1 lakh shares, but you got subscription for only 30,000 shares. 70,000 shares seems to be not recovered. Okay, under subscription. Because of the under subscription, I cannot go for honoring that. Okay, allotment is cancelled. So to that process, I spend around 5 lakhs rupees. What can we do, sir? That 5 lakhs cannot be debited to the P&L. It remains as a loss only in your balance sheet. Cost of issue in negative. Cost of issue in negative. But what expenses can be deductible? In case related to the buyback of shares, bonus shares, debenture issue. Because these things are involving no increase of authorized capital. Buyback shares reduces the shares capital. Bonus shares, the accumulated profit is converted into equity share capital. Anyhow, equity shares net worth remains the same. There is no any change. And debenture issue is not part of the capital expenditure. Okay? It means capital. As debenture is not being the equity share capital or preference share capital, issue expense related to that is called as revenue. Even issue of convertible debenture. Now you are issuing the debenture supposed to be convertible into the equity share sometimes later. Will it be considered as capital? No, sir. Currently it's debenture only, no. So it's not forming part of the equity shares. So it will not be deductible. It will not be deductible. Sorry, it will be deductible. Sorry. Clear? And the fourth point is all about CSR, corporate social responsibility, usually not deductible. So every company should spend at least 2% of their net profit for the society's well-being, well-off. Okay. So you grow because of the society support. So now it's your duty to support the society back. Okay. Here or there you might have seen, okay, the bus stand, beautifully designed and structured. So I've seen lots of bus stand came here around 10 to 15 years ago with air conditioned bus stops along with the mobile charger and all. Okay. I was amazed to see the next day, all the beggars were sleeping there. Okay. So sometimes later the mobile charges was broken. Later the door broken, everything broken. Now only the banner is still there. Okay. So these are called funded by corporates profit. It's a responsibility of the company as you are growing using the society. Now it's your time to give it back. At least 2% of your income, your net profit should be given to the society back by way of any CSR fund. Any CSR fund. Is that clear? Corporate Social Responsibility Fund. Now, who has to give that mandatorily? Mandatory CSR expenditure. As per section 135 of the Companies Act 2013, every company, listed or unlisted, or private or public, having net worth more than 500 crores or turnover more than 1000 crores or net profit more than 5 crores. Okay. One of these three. Automatically, CSR spending should be at least 2% or more than that of the average net profit made in the immediately 3 preceding financial years. Find out the average net profit of the 3 preceding financial year. In that, at least 2% you have to spend for the CSR activity. This will not be considered as your expenditure to be debited in your P&L account. It's an appropriation. It's an appropriation. You have to understand the difference between expenditure and as well as appropriation. Expenditure means is a charge and profit can be debited to the P&L account. It reduces the profit, and after the reduction of the profit, you can pay the tax on the balance. But in case of allocation or appropriation, whatever the expenses you've subtracted, first to pay to the government, and balance will be shared among the others. Okay, this is only appropriation. Donate for PM Relief Fund, PM Care Fund also be available. That will be considered as CSR fund only. Donate for Swachh Bharat and Clean Ganga fund also be is not available. This will be considered, but 80G deduction is not available. Clear. So if you are donating PM Relief Fund or PM Care Fund, of course that will be considered as the spending for the CSR condition is fulfilled. Not only that, you can claim the deduction under section 80G. We'll study that 80G series later on. All the 80 series, 80CCD, now and then I mentioned about NPS and here 80G. All these things we'll study along with the deductions chapter. No need to worry about that here. So in case of PM Relief Fund, PM Care Fund, you can claim, you can deposit and claim the deduction under section 80G. But in case of Swachh Bharat and Clean Ganga Fund, you can deduct, but you cannot claim the deductions under section 80G. But CSR spending does not include what? Activities undertaken outside India. That CSR fund, you use that fund only within India, not outside India. Apart from that, the CSR fund is used for employees' benefit is also disqualified. Already you offer some facilities to the employees, and CSR fund is also offered to employees' well-being only. So building the quarters and making some facilities to the employees and educating only for the employees, of course, not considered as qualified CSR activities. And political party, any contributions to the political party also be disqualified. Clear? Hope now you'll be able to understand mandatory CSR expenditure also. Clear? Now, please advise regarding admissibility of the following items for deductions. Payment of interest of rupees 40,000 on monies borrowed from bank for payment of dividends to the shareholders. Of course, you can claim the deduction under section 36 class 1 subclass 3 because department has no rights to question what's the purpose you are borrowing and why you pay so much interest. Those questions cannot be asked, so it can be deductible. 12,000 has expended for shifting of business from original site to the another place which is more advantageously located. So if you are shifting one place to other place, because of shifting you will be getting revenue increased for hereafter. Okay, current location you can earn around 1 lakh rupees. After shifting you can earn around 1.5 lakhs rupees. So the income increased from 1 lakh to 1.5 lakhs hereafter for any number of more number of years. Then that shifting expenditure being capital expenditure nature cannot be deductible. Cannot be deductible. Capital expenditure nature. Clear? Lump sum paid to acquire license regarding technical information to reduce production cost. So I currently manufacture myself. It costs me 10 rupees per unit to be manufactured. If I have the technical know support, I can manufacture it by 5 rupees. I can reduce by 5 rupees. So for that, technical support is acquired from some third party by paying additional amount. So 1 lakh or 2 lakhs. Any payment, because of that payment, if I'm getting extra revenue for any number of years, future 2 or 3 more years, if you are getting extra revenue, then that payment is called as capital expenditure. And any payment gives me cost reduction for future period, probably 2 to 3 years. Then also it's called as capital expenditure. So these two are not deductible, only revenue expenditure. I already told you no. As per section 37, it should be revenue expenditure related to the business, not being the fine and penalty because of violation of the act. Okay, these are the basic conditions you have to understand. Theft of stock in trade, assuming it is insured and it is uninsured. What happens in case of theft of insurance means stock allowable. Theft always happens in the organization, maybe considered as normal business expenses can be debited in your P&L account. If it is insured, what happens? Any insurance claim received will be considered as income. Okay. So 1,000 rupees worth of stock lost can be debited in P&L account. Any insurance claim received and can be credited in the P&L account. Usually, in case of theft, you don't show because in P&L account, no. In P&L account or trading account, purchase being 1,000 rupees or 1 lakh rupees. Okay. Where sale being out of 80,000 rupees worth of goods sold for 1 lakh. Closing stock when we verify, we have stock worth rupees only 10,000. What about the remaining 10,000 lost abnormally, sir? No problem. Automatically gets affected. This way we can show. Okay. So automatically it is adjusted. You no need to show the stock loss separately. Or you can show here abnormal loss as well as abnormal loss in debit side as well as trading credit side. That also you can show. But usually what happens, you will not show the value lost due to the theft or any other reasons in your P&L account for the income statement. But if you are receiving any claim, that will be definitely considered as your income. Okay, out of the 10,000 rupees, you receive around 6,000 rupees. That will be shown as your income. Receipt of insurance claim is PGBP. That stock loss will be your expenses can be simply debited to the P&L account. But already debited, no need to do any more adjustments. Now, section 37, clause 2B. The expenses not deductible. The expenses not deductible. Okay. Any expenses you incur for advertising your product is debited. Advertisement expenses related to the business can be debited to the P&L account, no problem here. Provided if you are incurring the advertisement expenses for publishing in souvenir or brochure of a political party, then this is specifically not deductible. Specifically not deductible. Section 27 2B. A is 1, B is 2, right? 2 means B. So 37 2B. Section 37 class 1 is all about general class and 2B is all about disallowed if you are spending the advertisement expenditure for publishing your advertisement in political parties, magazine and brochures. The second part I have to teach you along with the section 80 series. Okay, 80cc, 80G, G, C and D. We will study along with that section. So I just skip this for the time being. Section 38 was already completed because asset not fully used for the official purpose, partly used for the personal purpose. To the extent it is used for personal purpose is disallowed. So with that we have completed up to section 38. Section 40. Section 40A, 40 class A, subclass 1, subclass 1A, subclass 3. Let me finish up these three sections first of all. 1, 1A, 3. 1, 1A and 3. All the three sections are related to the TDS. Okay. For employer and employee, employee rendered service to the employer. For that, employer makes a payment to the employee, or payer and receiver. Receiver may render some services. Further, payer makes some payment, which is income for receiver. Services, for that income is there. For this income, receiver should pay the tax to the government of India. Okay, tax is payable. Employee rendered service to employee. Employee renders service to employer. Further, employer offers salary to the employee. For the salary, employee has to pay the tax to the government. In this case, for example, the salary payable being 1 lakh per month. 1 lakh per month. In P&L account of employer, salary is debited here. 1 lakh. Now the question is, tax payable on salary by the employee will be calculated and subtracted from the employee. Probably around 20,000 rupees or 15,000 rupees may be tax. Sorry. The tax is deducted, named as TDS. Tax deducted resource by employer. This tax is deducted Step 1, deposited with the government. Step 2, two activities will be done by the employee. Okay. So at the time of original tax payment by the employee, he calculates tax payable being 15,000 rupees and states that my employer already deducts this 15,000 rupees and deposited on behalf of me. Balance tax payable by me is zero. That's how he says to the government. He intimates to the government. So recipient is not paying the tax in case of salary. Who pays the tax? The payer. He himself deducts the tax for the tax applicable for the employee and deposits in the government. An employee, while paying the tax, whatever the tax already deducted, subtracted, and balance he pays. But while calculating the tax for the employee, he calculates 15,000 rupees salary tax for the salary. He may not have salary income. He may have the other tax, other income also, probably house property income, salary, interest income from the bank. On that also tax applicable around another 5,000 rupees. Overall 20,000 rupees already TDS 5,000 is there. Balance 5,000 will be payable. Balance 5,000 is payable. Is that clear? So in case of salary, the tax payable on that salary income is payable by the employer he himself. Is that clear? Similarly, for some other payment, a small number may be stated in TDS chapter. We'll study that later on. That number will be deducted and deposited on behalf of the recipient. So the payment, the income may be say 1 lakh. TDS may be 10%, 5%. The rate may be given. Sometimes it may be 1%, 2%, or all. We'll study along with the TDS chapter. Assume that 0.5 lakh, 5,000 is subtracted and deposited. Here also it involves two activities. What is that? Deduction and deposit. Deduction and deposit. Is that clear? And on final tax payment or finds the tax payment may be 1 lakh, where TDS being 5,000 rupees already deposited by the payer, balance 95,000 is payable. In case of salary, 100% tax is paid with the employer. In case of other than taxable income, salary income, some number is given like 10%, 5%, 2%, 1%. That income only, that level only you have to pay the TDS. Okay, what's the reason of paying this one? Even 1% also may be possible. What's there to pay only 1%? Because of this reason, or has to disclose in his P&L account the amount collected 1 lakh. No other way. He cannot escape without showing this one. Or says that, sir, I don't have any income. Immediately government says, no, you have some income. 1% is collected and deposited by your payer. It means 1% is this much, means full value should be 1 lakh. You might have collected 1 lakh. Where is that? So you will be getting caught because of the reason. Understand? So it is only showing your income to the government by the payer. By the payer. That's the logic. So you cannot cheat. You cannot escape. That's the logic behind the TDS concept. TDS as well as TCS. In both the cases, whatever the income you generate, a small number is deposited with the government on behalf of you. And based on that number, while tracking your records, for that number, there should be revenue. No, the government verifies whether there is a revenue or not. If you are not showing, then automatically a scrutiny will be raised and notice will be sent to explain this situation. So then you will be getting caught. That's the reason you have to understand here. Clear? Two aspects are there. One is deduction, another one is deposits. In case of first one, we'll start with the first one. What's that? In case of R, a resident, non-resident, NRI. NRI can support me by what? Loan or technical know-how or some patent. For that, you have to pay. Resident has to pay interest for technical know-how, maybe fee for technical services, patent for that royalty is payable. If this payment being 10 lakhs, maybe TDS is applicable. Now, what is the role of R? He has to deduct the TDS and deposit the TDS on behalf of him with the government second. Two steps are involving. Clear? Now, so NRI, where is he? Where is he? Okay. NRI, situation 1. Another one is R. Another R. He is also resident. He supports loan, technical know-how and patent. For that, interest, fee for technical service, royalty is payable. Royalty is payable. Is that clear? But R is not in India, outside India. This NRI may be in India or outside India. Doesn't matter. These are the two scenarios. In these two scenarios, TDS is deducted and deposited with the government. Step number 1, TDS deducted. Step number 2, deposited with the government of India. Clear? Now, this deduction should be before 31st March of the previous year, and deposit should be before the due date for filing of return of income. Filing of return of income means 31st July or 31st October. Within the date, he has to make the payment. Clear? If failing of these two, naturally what happens now, in the P&L account of this person cannot be debited interest, fee for technical services and royalty amount. What they have paid here, no. Disqualified to be deductible under section 40 class A. Disqualified for deduction. Government is strict that whatever the income you are paying, the recipient should disclose to the government in his return of income, and he has to file the returns also, pay the tax. How can I track whether he generated the income or not? If you are being the payer, whatever the income like interest, fee for technical service, royalty, if you are paying to anybody outside India or to non-resident in India, wherever it may be. Okay. In these cases, TDS should be deducted within the end of the financial year and deposited within the due date of filing of return of income. It is not so, then you cannot deduct the expenses. This cannot be deductible. If these expenses not deductible, what happens? Your income will be inflated. For the inflated income, you have to pay the tax. So, interest, royalty, fee for technical services are in the payment. Payable outside India. Outside India to whom? Anybody. Maybe resident, non-resident. He may be resident and non-resident, doesn't matter. Or payable to non-resident where? Maybe in India or maybe outside India. Without TDS deducted in the current previous year, that is before 31st March, the first one, or TDS deducted in the previous year, not deposited before the due date of filing of return of income. Okay, even this one is missing or both are missing, automatically it is disallowed to be deducted in this year. Sir, what happens if the TDS is deducted and deposited the next year, sir? Then okay, you can claim the next year. You can claim the deduction in the next year. So, allowable in the subsequent previous year in which TDS is deposited. Is that clear? In this year, it is disqualified, but you can claim the deductions in the next year. You can claim the deduction in the next year. Sir, if I fail to pay the deduct the TDS, sir, but my NRI recipient promptly declared this income and paid correct tax, he himself, sir, without TDS. What happens in this case, sir? That case also considered as no need to worry. You can claim the deduction, but it takes only later period, not in this current year. Okay, because he pays the tax only in the next year. So we get the details only in the next year. So we will be eligible for claiming the deduction only in the next year. Hope you will be now able to understand this one. Clear? Point number 1 is over. Scenario 1A, similar case. Scenario 1A, similar case, but recipient being resident. In the earlier case, recipient being either NRI, if he is being resident, but payment is made outside India. Both seems to be external, like the restriction is pretty high. If you are making the payment to resident within India, what happens? The same TDS provision is applicable, but if you fail to deduct the TDS and deposit within the due date for filing of return of income, not the 100% disqualified, only 30% disqualified. To the extent of tax and that income is disqualified. Whatever the income may be, usually the tax rate being 30%, right? So government says whatever the expenses you debit to the extent of 30% is disqualified, balance can be deductible. 100, 70 rupees can be debited, 30 rupees cannot be debited, provided the recipient being the resident. If the recipient being non-resident, or in case receipt may be happening outside India, in those cases, first provision means 100% disqualified will be applicable. So here what happens? Without TDS deducted in the current previous year, or TDS deducted in the previous year but not deposited before the due date. So number one, number two, 2 points are there. Automatically disqualified. How much? Only 30% is disallowed. Sir, is there any escape, sir? Can I deduct it further later on? Yes. Allowable in the subsequent previous year in which TDS is deposited. In the subsequent year, if TDS is deposited, then you can claim. Note 2. Tax not deducted, but the recipient has furnished his ROI and furnishes certificate from form number 26A. Then it is assumed that TDS is deducted on the date of ROI. Okay, on the date of ROI. So we have not deducted the TDS. The recipient says, "Don't worry, sir. I will pay the tax on behalf of myself. Myself." So you don't need to deduct the TDS. So for that, he has to get it certified under form number 26A. In that case, once he submitted, he surrenders and I can claim the deductions. Disallowable will not arise, but 30% disallowed is deductible in the next previous year. You can claim the next year, not in this year. The next year you can claim. Either you can deduct and deposit in the next year and enjoy the deductions in the next year, or let him deduct he himself and pay. Let him file the return of income and pay the tax on behalf of himself. No problem. In that case, also you can claim the deductions. Assessee is not treated as assessee in default. Okay, this point you can study later. Clear. Third point is all about similar to the first one. So the first one and the third one are same. But one thing here, loan, technical know-how, patent know, rather than salary case. Employer paying the salary to either non-resident individual or resident where the payment is outside India. In both the cases, third provision will come 100% disallowed. But the main difference between the first point and third point is, in the first point, subsequent year, if collected and deposited, you can claim the deduction. In case of salary part, you have failed to deduct and or deposit within the due date in this year, 100% disallowed. Not only in this year, hereafter you don't have the options to deduct in the subsequent years also. Right? So that's the main point you have to understand. Salary payable to any person outside India or in India to non-resident without tax or not deposited within the due date of TDS payment. It is not due date of filing of return of income. Within the due date for the payment of TDS. Usually TDS due date for TDS on salary due date being 7th of the next month. January means 7th of February will be the deadline. Note, not allowable in the subsequent previous year in which the TDS is deposited. Sir, this year we missed. Next year if I deposit, can I claim? No, once disallowed means disallowed is permanent. Okay, even TDS is deposited out of own fund. Can I deposit the TDS out of my own fund without deducting? No, that case also it is disallowed. Why, sir? Anyhow, he paid the tax. Tax on the employee's income paid by the employer is a perquisites. That will also be considered as taxable income. We have studied under salaries chapter. You understand? So, it is also disallowed. Hope 3 main points related to the TDS concept is over here. Clear? Number 1 being interest, fee for technical services and royalty payable to non-resident or resident outside India. In this case, if you are not deducting within the year end or deducted but not deposited within the due date for return of filing of return of income, then disqualified 100%. Subsequent year, if it is deposited, of course, you can deduct in the subsequent years. But third point, in case of salary, the same thing will be happening, but once disallowed means it's permanently disallowed. We'll never bother about the due date for filing of return of income. Here, the botheration is with respect to the TDS duty. Okay. And in case recipient being the resident, the same case will be there, but only 30% is disallowed. Now, second point already we studied. anything related to the income tax and penalty, interest, fine for non-payment or late payment of income tax, nothing can be deductible. Already we studied, no. Income tax and income tax related any item, penalty, interest, whatever it may be, not deductible as per section 37 and section 48 class 3. But in case of indirect taxation, of course, you can claim. In case of indirect taxation, you can claim. In case of direct taxation, you cannot claim. And and I have to cover up 4 any payment to employees provident fund or other fund. So employer, employee, employee rendered service here. For that, employer makes the payment salary 1 lakh. For that, PF being say 10%, 0.1 lakh. Employer deposits this with RPF fund. 10,000 employees contribution, 10,000 employers contribution. In case of RPF, if employee resigns and withdraws the money within 5 years, what happens? 20% is 25% is disqualified, that will be taxable. That's how we studied. Statutory provident fund completely exempted. PPF completely exempted. Unrecognized provident fund not considered at the time of investment but on withdrawal completely taxable. But in case of RPF, at the time of deposit, subject to provision will be deductible. 12% on salary will be exempted. Beyond that is taxable. Interest on such fund will be exempted to the extent of 9.5%. Beyond that is taxable. That's how we studied under salaries chapter. On withdrawal, completely exempted if it is withdrawn after 5 years. If it is withdrawn within 5 years, what happens? It will be taxable. It will be taxable to certain conditions, based on certain conditions. So, within 5 years, if it is withdrawn in 5 years, it is taxable, Employee may cheat without showing that I have withdrawn within 5 years, so there is tax payment. He has to make the payment, no? If he failed to pay the tax, the government may not know this. So government now wants the employer, if you are depositing in RPF for the employee's purpose, intimate to the RPF department. If he gets the money back within 5 years, insist the RPF to deduct the TDS on this money. It is not employer's side fault. It's what about the connection? He has to intimate to the RPF department. If the employee resigns in 5 years, while releasing the lump sum payment from the RPF to the employee from the RPF fund, RPF has to deduct the TDS. If it is not so, while depositing, this amount cannot be deductible in the payment. Right. So, any payment to employees, PF or other fund, if no arrangement is made with such fund for deducting TDS at the time of payment. So, while making the payment to the employee, if TDS is applicable, now it is the responsibility of RPF to deduct the TDS. Such a way, employer has to intimate to the RPF department. If he fails to do so, then employer cannot debit that amount in the P&L account. This amount cannot be debited to his own P&L account. Is that clear? Hope you will be now able to understand. Now, any tax actually paid on perquisites, otherwise tax on perquisites not deductible. Tax on perquisites not deductible. Already we studied this in the very first instant itself about norms to fall under salaries topic. Okay. So, tax payable on salary deductible. Tax payable on perquisites disallowed to be debited. Okay. This is disallowed. I think we referred that in salaries chapter. Go and see that. Okay. See, employer, employee, service is there, employer use salary 1 lakh per month, also perquisite around 0.1 lakh. Applicable tax for salary 10,000, for perquisites 0.01, 10% assumed. Also paid by the employer to tax department. To tax department. Clear? For PGBP as well as for salary. Come on, tell me. What is the salary income for the employee? Salary being 1 lakh. Taxable perquisites being 10,000. Tax on salary 10,000. Tax on perquisites. This is not considered for the taxable income. So taxable salary for this, for him being 1,20,000 rupees. In PGBP, in P&L account debit side, employee cost, salary 1 lakh, perquisites paid 10,000, tax on salary 10,000, tax on perquisites 1,000. In this case, this one is disallowed under section 40 class A subclass 5. So, income for employee will be equivalent to expenses for the business. Expenses for the business. In PGBP, they will show 1,20,000 being the expenses. For salary, 1,20,000 being the income. Tax on salary is a part of income. Tax on perquisites is exempted in the hands of the employee. Similarly, for the business, tax on salary is expenses. Tax on perquisites disqualified under section 40 class A subclass 5. So with that, section 40 class A concept is over. Now we'll see some illustrations here. So we have seen 3 related to the TDS. One is related to the income tax. Another one is related to the PF. Last one is all about tax on perquisites. Okay. Around 6 items we have referred here. 6 items. Come on, let's try this one. Delta Limited credited the following amounts to the account of resident payees in the month of March 2025 without deductions of tax at source. So, recipient being resident, then how much is disqualified? Only 30%. What would be the consequences of non-deductions of tax at source by Delta Limited on these amounts during the financial year 24-25, assuming that the resident payees in all the cases mentioned below have not paid the tax, if any, which was required to be deducted by Delta Limited. So they have not deducted the TDS. So salary case, payment is made but TDS not deducted, then disallowed will be 30%. How much is that? 3,60,000. Director's remuneration on this also TDS not deducted, so 30% on this being 8,400 disallowed, disqualified. So amount debited to the P&L account being 8,40,000 only. Here 19,600 only. To this extent, income will be increasing. For that, you have to pay extra tax. You have to pay extra tax. Rather than he is being the resident, non-resident, then automatically what happens? 100% may be disallowed. 100% may be disallowed. Clear? Section 40 Clause A provision. I think I may complete the class with the 40 Class B today. 40 Class B. 40 Class A, 40 Class B. Rest will complete by Sunday. Okay. Tomorrow we have accounts class. Okay. Now let's try to solve this illustration. I think this question you can solve after completion of TDS chapter. Okay. I need to guide you the TDS chapter provisions, only then you can link that here. So because of that reason, I don't want to teach this now. Clear? You can link with which chapter? TDS chapter. We'll directly move on to section 40 class B. 40 class B. We'll now section 40 class B. Partnership firm assessed as such. Partnership firm assessed as such. Actually, partnership firm can be assessed as such or can be assessed as either AOP or VOI. These are the two modes we have. Partnership firm assessed as such or partnership firm assessed at AOP or VOI. Clear? This part you no need to worry about. Will be applicable for I think CMA Inter, not for the CA Inter. Okay, this will be applicable for both. We try to finish up this one first of all. Falls under section 1040 class B. From section 40 onwards, usually disallowances are going to be listed. Section 40 class A, we have disallowances. All the deductible items were already completed up to section 37. From 40 onwards, disallowances list are there, especially section 40 class A, TDS and income tax related expenses and the PF, perquisites tax and all. In section 40 class B, if the partnership firm valued as such, then there are some disallowances, some allowances are paid. Okay. Now, so in this case, deed and PSR, profit sharing ratio, should be mentioned. There should be deed as well as PSR to treat this being partnership valued as such. Section 40 class B, in case of partnership firm and even applicable for LLP, the deduction on account of interest and salary paid to its partners are limited. Interest and salary payable to the partners are limited. Okay. In case of interest and salary, payable should be authorized in the deed. Number one, and number two, it should relate to it should not relate to the period before the date of such deed. So, deed not executed. Just in this year we executed, that too in 1st January 25 executed. In this deed, clearly stated that interest is payable from this date onwards. While preparing the P&L account, you cannot claim the interest from 1/4/24. For this period, you are not eligible for claiming the interest and salary. If you are preparing the deed as a fresh, and automatically from the deed only you are eligible for claiming the interest as well as salary. Okay. So not related to the period before the date of such deed. It should be authorized in the deed that interest and salary payable to the employees, partners is authorized. Apart from that, not only that. So what's that? It should be from the date of deed. Now, let's start with the first one, remuneration part. Only two items. What are they? Interest and salary. Only these two parts. Salary part. Remuneration includes salary, bonus, commission, by whatever name may be. Provided it should be for the working partner only to get the salary, bonus or commission. Okay, to partners. Usually all these things put together, commonly called as remuneration, will be payable only to whom? Working partner. If he is being only sleeping partner like or partner in profit share only will not be eligible for salary. Okay. And second point one being partner should be individual, else not eligible. Individual partner. Okay. Individual. Is that okay? Partnership between X and Y limited. X being the individual person, Y is company. Can these two form a partnership firm? Means, oh, of course, you can form partnership firm between one individual as well as one firm, one company. In this case, X can claim the interest on capital, or sorry, X can claim the salary and bonus, whatever it may be. For Y limited, it is not eligible. It is not eligible. Is that clear? So, individual only can be working partner for any number of firms. Partner being company or hub cannot be a working partner. Hope you will be now able to understand the remuneration concept. So remuneration will be payable only to the working partner. That too, he should be individual. In case of interest on capital, maximum 12% will be allowable. That too, simple interest. On partner's capital or loan, maximum 12% is allowable. Beyond that, not allowable. Is that clear? Now, we'll see this point later. And in case of salary, bonus, commission, or any of the remuneration allowable for the working partners? No, subject to some condition. Okay. So in case profit or loss from loss to 6 lakhs. Okay. The remuneration payable to the working partners will be whichever is higher of 3 lakhs or 90% of book profit. Profit in excess of 6 lakhs. You understand? In case the partnership firm is a loss making, 1 lakh loss, do I want to give any remuneration to the partners? Yes, of course. How much? Minimum 3 lakhs. If the partnership firm makes a profit of 5 lakhs, how much I have to give? 3 lakhs or 90% of this amount, 4.5 lakhs, whichever is higher, 4.5 lakhs will be payable. Hope you will be now able to understand. Even if there is a loss, 3 lakhs will be guaranteed maximum remuneration payable to the working partners. Similarly, if the profit is less than or equal to 6 lakhs, then whichever is higher of two numbers, one is 3 lakhs flat, another one is 90% of the profit, whichever is higher will be payable. If the profit is more than 9 lakhs, up to 6 lakhs, beyond 6 lakhs, up to 6 lakhs, the same condition will be applicable. Profit beyond 6 lakhs, no. On that, 60% will be offered to the working partners. These are for working partner. Working partner may be single partner or 2 or 3 partners joined together take care of the business. Then this limit is for all the partners put together. This limit will be all the partners put together. Now, interest on drawings credited in P&L account. No need to adjust with the interest on capital. Interest on drawings. If any interest on drawings is collected, credited in the P&L account, what can we do, sir? Don't disturb that. The 12% interest on capital and loan is restricted only for the interest on capital and loan, not adjusted with the interest on drawings. So interest on capital is the expenses for the business. Interest on drawings is the revenue for the business. Can we neutralize that? No. Interest on drawings is simply credited in the P&L account. Interest on capital is debited in the P&L account. That too, to the extent mentioned here, 12%. Okay. Hope these are the 2 points. Only these two, interest and salary. So in case of interest, of course, you can claim the interest at the rate of 12% on the capital as well as loan. And in case of salary, up to 6 lakhs of profit, 90, whichever is higher of 90% of salary, 90% of profit or 3 lakhs. If the profit being more than 6 lakhs, up to 6 lakhs, existing value will be given. Beyond 6 lakhs, another 60% of the value will be given for all the working partners put together as a whole. It's not independent working partners put together. And that salary and interest should be in the deed. And then this will be allowable only after the incorporation of these points in the deed. Okay, earlier period not applicable. And then the salary will be payable for the individuals only, not being the company. Is that okay? Hope you will be now able to understand all these things. Anyway, you might have seen that this 90% profit will be book profit. Okay, book profit. Now you have to understand what is called book profit. What is called book profit? Let's try to solve one illustration, 1 and 2, 4 illustrations we have. We try to finish up all the 4 illustrations. After solving all the 4 illustrations, I'll finish up the theoretical background of this part. So with that, section 40 class B is completely over. Okay, this book profit format I have given no. I solve along with the illustration and then I brief this format. Okay, now let's start with the first illustration. Come on. Brindavan Company is a partnership firm consisting of 4 partners: Ram, Rahim, Robert, and Rakesh. The firm made turnover 100 lakhs and net profit of the firm being 9 lakhs 50,000 rupees. So net profit being net profit as per the books, financial accounts, 9 lakhs 50,000 rupees. 9 lakhs 50,000. Shop rent paid for premises to partner Ram 22,500 per month. Okay. No tax was deducted at source. Any payment subject to TDS, right? But if TDS is not paid, then disallowances will come under section 40 class A. The recipient being the resident, so full amount not disallowed, only 30% is disallowed. 22,500 into 30% is disallowed per month for 12 months. What's the value? 81,000 rupees is disallowed. So if that 81,000 rupees you debited in P&L account, disallowed means you have to remove from the debit side of the P&L account. If you are removing from the P&L account, profit will be increased. So you have to add this one. Okay. Disallowances. Disallowances of rent as no TDS deducted. 81,000 is disallowed. That will increase the profit. Depreciation as per income tax rule being 1,50,000. Interest on capital to partners 15%, 1,50,000 as authorized by the deed of the partnership. Right. Now what happens? You can claim the depreciation deductible under section 32. 1,50,000 can be deductible. This one is addable. This one is deductible. Is that okay? 81 is added. 1,50,000 deductible. Interest on capital to partners at the rate of 15% on 1.5 lakhs. Already debited should be removed because interest on capital allowed only to the extent of 12%. 3% extra allowed is disallowed. So remove that. Excess debit is now removed. Interest on removed means if you remove the profit will increase. So interest on capital. Okay. But what happens here in this case is before considering, it means they have not deducted this one. Okay. Now what happens here? 1,50,000 rupees. How much you can claim the deductions? Only 12%. So what is that value? 1,20,000 is deductible. 15% being 1,50,000. How much is allowable? Only 12% is allowable. Find out the value by doing the cross multiplication. 1,20,000 is deductible. Clear? Working partner salary to each partner 15,000 per month will not be considered here. Come on, find out the value. The value what you get here is called book profit. So book profit is nothing but from the net profit what you have calculated, net profit or loss calculated based on the based on your P&L account. From there, as per the income tax provision, do plus or minus to get the final value. That's called book profit. So here the book profit being 7,61,000. Now from this, you can claim what? Salary. You can claim the salary deduction. How much is the salary? 7,61,000. Now segregate that to up to 6 lakhs and beyond 6 lakhs. Up to 6 lakhs, beyond 6 lakhs. For this, whichever is higher of A, 3 lakhs, another one is B, 90% on this value, balance, 90% of value. How much? 5 lakhs, 40,000 rupees. 5 lakhs, 40,000 will be taken. And here, 60% will be taken. What's the value? 96, 600. So this one is also be claimable. So total value deductible in this case being these two. Come on, what's the value? 6 lakhs. Salary as per section 40 class B. 6 lakhs 36,600. What's the actual salary payable? 15,000 per month into 12 months for each partner. How many partners we have? 4 partners. You multiply with 4. 7 lakhs 20,000 rupees. This is actual. So the salary calculated as per section 40 class B are actual. Whichever is lower is deductible. Whichever is lower is deductible. 6 lakhs 36,600 is deductible. Balance is taxable PGBP. How much is that? Clear? Let's see. For the calculation of book profit, PGBP after all adjustment. After all adjustments means all you have to take care of all the plus or minus. There may be some expenses debited, but usually you may not debit. Then you can subtract from the income. You might have debited as per your actual financial report, but income taxes you should not debit. So those things will give the rise to the business income. You add that back. Such a way you get the PGBP income as per the taxation purpose. Apart from that, remuneration what you have already debited in the P&L account should be added back because we supposed to calculate the remuneration hereafter only. So you have to add the remuneration back. Interest also to the extent of 12%. All the remuneration to the partner should be added back. Then the value what you get is called PGBP. From the PGBP, you can claim the salary deductions. Okay. So the salary deduction from the book profit. Okay. This point I have to explain the next illustration. So this point what we have calculated this illustration is equal to the PGBP. So book profit. From there you can claim the salary. Is that okay? So we have done this one. We have done this one. Is that clear? So what we have to do? The profit and loss given as per the financial accounts will be the starting. With that, you have to do some plus or minus with respect to the various income and expenses allowed under section 30 to 40, 40 or 38, 37, 40 disallowance. All these things are adjusted. And remuneration to the partners, if any debited, that should also be removed because remuneration to the partners are going to be calculated separately. So you add back and final value will be the book profit. Hope you will be now able to understand. In this illustration, we started with net profit as per the books. This one is disallowed. Deduction not considered. So you consider deductions for the depreciation and interest on capital not considered. Up to 12% is allowable. Deduct this. After this, you will get the book profit. From there, you can calculate the PGBP income. Is that clear? Okay, then rest I will continue in the next.